Hello, everybody. Thanks for coming for this first day of the Economics of Digital Currency workshop. We are very happy with all our participants, so our panelists, and our attendees. So I will open for Jonathan to give like his opening speech. Thanks, Jonathan.
All right. Hello, everyone. I want to welcome you from different continents and in different time zones. So good morning, good afternoon, or good evening, wherever you may be. Welcome. The workshop is organized jointly by the Bank of Canada, Rutgers University, the JEDC, and the SAMMF. As you might know, Todd and I originally planned to host a small one-day workshop in April. Now, with Bruno's help, it has become a 3-day virtual conference and allowing us to reach many more participants. When I checked yesterday, we have over 300 people registered. So I'm really excited and looking forward to 3 days of insightful presentation and fruitful discussion. Now, without further delay, I will let Bruno go over the rules.
Thank you, Jonathan. So the SAMMF are very happy that be able to help you guys. And we have like Jonathan, Todd as I mentioned, like the main organizer. Thank you guys for letting us join you guys in this project. It's been kind of nice workshop, and we're happy to have a part on it. So each paper is gonna be like 10 minutes, and we are having 10 minutes discussion. And we are gonna have 15 minutes in the Q&A. So we are gonna have moderators that will try to kind of organize and keep the time. We are gonna have panelists that can ask questions at any time. And we have our attendees. So attendees can use the Q&A feature of Zoom to post questions. If co-authors are on, they can try to reply. And some of these questions will be brought back in the 15 minutes Q&A in the end, if we feel like they were not replied to satisfaction. Okay, so without further ado, I'll call Michael Kumhof to start the first talk. So Michael, you should be able to share your screen now.
Yeah, can you see it?
Yes.
Okay, so thank you for putting our paper on the program. This is a paper that I wrote with John Barrdear at the Bank of England back in 2016. The title is The Macroeconomics of Central Bank Issued Digital Currencies, and the Bank of England disclaimer applies. By way of introduction, the emergence of Bitcoin and similar e-monies was a key moment in the emergence of, or in the history of e-monies, in that it may now for the first time be technically feasible for central banks to offer universal access to their balance sheet. Existing centralized RTGS systems were not thought to be capable of doing that, not robust for universal access. They typically give access to a few hundred participants at most in their current configuration. And the new systems can potentially solve this problem, but as economists, the question we set out to do is it economically desirable to do so? To do so, we first define what is a digital currency. I can keep this brief in this audience. So in traditional electronic payment systems, we have tiered ledgers where payment verification is done by specific third parties and organized in a hierarchical network. With digital currencies, you have distributed ledgers where payment verification is done by multiple third parties in a peer-to-peer network. And then a central bank digital currency, we think of for the purpose of this paper as access to the central bank balance sheet that is universal, i.e. banks, firms, and households, electronic, national currency denominated, that's very important, issued against government bonds, could also be through spending, but we don't dwell on that here, interest bearing to equate demand and supply at a one-to-one exchange rate, because the issue is if you were to, let's say, over issue such a currency and you don't have an interest rate that can equate demand and supply, the general price level would have to equate it. And as central bankers, that's not something central bankers would like. And that then gives you a second tool of countercyclical monetary policy. And again, critically, we see this as coexisting with the existing banking system. Now, this is a world that none of us has ever seen. And so we basically set out back in 2016 to build a DSG model as a laboratory to think about what the relevant issues would be. Here's the broadest overview. The model is based on my work with Jeremy Benes on the Chicago Plan Revisited and Zoltan Jakab on banks are not intermediaries. The non-monetary model elements are mostly standard. For households, deposits, they hold deposits, they are created by banks, they hold CBDC, that's created by the central bank. Deposits and CBDC jointly serve as a medium of exchange with imperfect substitutability. The government conducts fiscal policy, it conducts traditional monetary policy, but then in addition, CBDC monetary policy. Here's the overview of banks specifically. For loans, we use a modified Bernanke-Gilchrist framework with difference number one, that lending rates are pre-committed, so there are possible bank losses. Difference number two, there are minimum capital adequacy rules imposed by the regulator. There's possible net worth then, first because of the MCAR, and secondly, as a shock absorber to protect yourself against losses, because when you violate the MCAR, you have to pay a penalty. There are 4 different loan types, and this is carefully calibrated to US data as of 2006 prior to the crisis. Then on the deposit side, we have Schmidt-Rowe and Uribe transactions cost technology. The difference there is that money in this framework is not high-powered money, but it is this imperfectly substitutable aggregate between bank deposits and CBDC. And there are 4 different deposit types held by households, and also another deposit type held by financial investors. Specifically now wholesale banks, the balance sheet is that loans are equal to deposits plus net worth. The heterogeneity reflects idiosyncratic risks that are not related to credit risk, but to other earnings or expenses. Capital adequacy regulation stipulates that there is a penalty as a fixed fraction of loans next period if at that time net worth is less than epsilon times total assets. That epsilon is therefore the minimum Basel ratio, which we have calibrated at 8%. And in each period, a fraction of banks, because there's a continuum, violates this regulation and pays. The optimization problem is then to maximize the difference between the return on loans minus the cost of deposits minus net losses from retail lending banks minus penalties on banks that violate the Basel rules. The optimality condition that comes out of that, one for each loan type, is equal to this. That's basically the wholesale lending rate, where X is the superscript for the loan type, minus the deposit rate, is equal to a spread that depends on the minimum capital adequacy ratio, on the penalty coefficient for breaching that ratio, on the risk weights for different loan types. I didn't get into that, but they're also present and they're calibrated based on data. And on the riskiness of banks as given by the CDF and PDF that enter into the optimization problem. Then we have retail lending banks. These are basically BGG banks with the modifications mentioned earlier. There is a loan contract that specifies the nominal loan amount, the unconditional nominal lending rate payable if no default, and willingness to lend coefficients that generally can differ from 1, and that basically tells you what fraction of the available value of collateral do banks take into account when they make loans, and that can, in this model, differ from 100%. The collateral, there is different types of collateral. Real stocks, i.e. capital and land, are used as collateral. Real flows, like output and labor income, are used as collateral, and financial stocks, bank deposits, and CBDC. The retail lending banks have, as in BGG, this ex ante zero profit condition that almost all of you will be familiar with, and that is then incorporated into the household optimization problem. Turning to households, they have the following largely standard preferences: habit persistence in consumption, disutility of hours worked, and utility from land. A is land. There are a number of adjustment costs. First, for financial assets, for every 1 percentage point increase in the government debt to GDP ratio, there is a 2 basis point increase in the risk-free lending rate, the policy rate. That is, and it is introduced into the model by way of a asset holding cost. And this value of 2 basis points is something that a number of papers for the US have found, including Laubach, but several others that are quoted in the paper. For prices and wages, we have inflation adjustment costs. For physical investment, we have Cristiano, Eichenbaum, and Evans costs on the rate of change of investment. And we have the Schmidt-Grohe and Uribe monetary friction, on which this slide, we have this friction that is the standard 2004 SGU. The shock SMD is a shock to the demand for total liquidity that will play a role later. And we interpret that as a flight to safety shock, as wanting to hold more money or liquidity for the same amount of real activity. And V is velocity, that's the key variable that enters there. And the velocity is expenditure over money. And the sector-specific expenditure, there are four different velocity items. Sector-specific expenditure is, one is consumption, the other is investment, the other is factor payments, the other is real estate. And then money, that is sector-specific monetary transactions balances, is here in just stylized form, is this CES function in deposits and CBDC, although prior to the introduction of CBDC, it is just deposits. And what you then get out of this monetary transactions cost is a monetary distortion that we will refer to as liquidity taxes. And as I will show, the effects are equivalent to consumption and capital income taxes in the first order condition. The distortion is a shortage of liquidity relative to the Friedman rule, which can never be eliminated in this model because money is created by banks, and the cost of creating bank deposits can never go to zero because banks have to earn a certain return. They have market power, they're regulated, there are all sorts of frictions there that mean that that can never be completely eliminated, that shortage. For the FOCs, for sort of condition, I want to be very brief and just sort of give you the flavor. For the consumption, we have this first order condition. Marginal utility of consumption is equal to marginal utility of wealth times the gross tax rate times the effective price of consumption. That's that last bracket, the monetary wedge, which is, you can see it there explicitly, it enters just like the consumption tax wedge. And there are similar wedges in the model for the investment first order condition, for factor input first order conditions, and for the land first order condition. The capital first order condition is this expression, and what is different there is what I call here, for lack of a better word, the collateral wedge. This is basically, again, a BGG term. And there will be similar wedges for all assets or flows that are used as collateral, namely land. It's also in the Phillips curve because output is used as collateral. It's in the hours worked condition because labor income is used as collateral. And for deposits in CBDC because they are also used as collateral. Next group of agent is the financial investors. They have mostly the same preferences and also the same parameters for consumption and disutility of hours worked. But we have liquidity in utility. So this is different. It's not a Schmidt-Grohe and Uribe transactions cost technology, but liquidity in utility. The reason for this is that we need basically the marginal investor in deposits to have a reasonably high interest semi-elasticity of deposit demand, because otherwise any changes in lending and in the financial system, the balance sheet size, will lead to very large changes in the deposit interest rate and the spread between the policy rate and the deposit interest rate, which is not realistic. So we think of these as the wholesale investors that are the marginal investor and that are willing to absorb large quantities of marginal deposits for only small changes in interest rates. Their first order conditions, only the ones that are key for government bonds. We have this condition here that looks familiar except for this phi b term. That's basically the small elasticity of the real policy rate with respect to the bond stock that I talked about earlier. This is important because the bond stock will be affected by issuance of CBDC. And then bank deposits, the same thing plus one additional term, which is that utility related term just before the equality sign. And that gives you the high elasticity with the right calibration, the high elasticity of deposits with respect to the real deposit rate, which ensures a fairly constant, but not entirely constant spread. There will be a change, and for large enough stock changes, there will be a substantial change in the spread between the deposit and the policy rate, but it will not be outrageous and unrealistically large because of this high elasticity. Then turning to policy, fiscal policy, this is the government budget constraint in this model. B is bonds, G is spending, tau is taxes, TRF is transfers. And then you have these other terms that relate to CBDC, and you see that that basically enters in a very similar way to government debt, except that the interest rate RM on CBDC is lower than the interest rate R on government bonds, and that is because CBDC is a transactions medium with a convenience yield, and with a positive convenience yield, the financial yield will be lower than the yield on a risk-free but non-monetary asset. The fiscal policy rule is then formulated like this. Basically, first we define the overall deficit to GDP ratio, which is typically defined as the change in nominal government debt over nominal GDP. And what we do here is, instead of the change in nominal government debt, is the change in the sum of nominal government debt and CBDC relative to GDP. What that ensures is that potentially volatile seigniorage flows, which involve a flow between, in private holdings, between holdings of CBDC and holdings of government bonds, i.e. Flows within this total of B plus M, those flows will then not be destabilizing on the deficit, and because the deficit is used to calibrate fiscal rule for taxes, they're also then not destabilizing for taxes. That actually turns out to be pretty important. So that's for fiscal policy. For monetary policy, this is the standard Taylor rule, standard forward-looking with 3 quarters ahead annual inflation, goods price inflation, and interest rate smoothing. Monetary policy, now turning to CBDC. The question is, CBDC could become big on a central bank's balance sheet, and the question then is, should we target that monetary aggregate itself or an interest rate on CBDC? And we've had that debate before in the 1980s, and we have to revisit those arguments. One argument against targeting the aggregate was that you would have trouble defining the relevant aggregate because most of broad money is not under the control of the central bank, but under the control of private banking system. That does not apply to CBDC because CBDC itself can be directly controlled, and it can be a large portion of the overall money supply. Problems in controlling the aggregate, same thing. However, there's a famous paper by Poole that there may be lower benefits of controlling a monetary aggregate than controlling an interest rate, especially because if money demand shocks are important. That does apply in this model, but as I will show, much more weakly than in Poole. And the reason for that is that banks remain the creators of the marginal unit of money rather than the central bank. Poole had in mind a world where the central bank was literally controlling every last unit of money. To study that third argument, we need to define CBDC policy rules, and this is the first attempt at doing this. And this is just basically saying we could control the quantity. So the first one is quantity rule, saying the quantity of CBDC relative to GDP is something we want to control, and perhaps responding to inflation, just like the regular policy rate. And so this would mean fix the quantity of CBDC and let the interest rate on CBDC clear the market, not the general price level. I alluded to that earlier. If M pi p is greater than 0, this would remove CBDC from circulation in a boom. And you want that because in a boom, there is more activity than you would like. And by removing part of the circulating medium from circulation, you would cool down the economy at the margin. The alternative would be a price rule for CBDC, where you fix the interest rate at a certain margin under the policy rate, remember the convenience yield, but again, with possibly a feedback to inflation. In this case, you let the quantity of CBDC clear the market. How that works, I'll talk about it later. But again, with the feedback to inflation having a negative coefficient, it means in a boom, we make the interest rate on CBDC less attractive, which means that people will want to hold less. And if they hold less, there is less transactions medium in circulation, and that helps to cool down the economy. So the story then is ultimately the same. And here's the idea with the whole convenience yield is on the horizontal axis, the quantity of CBDC, vertical axis, the interest rate on CBDC. The purple line is the interest rate on CBDC. As I pump more and more CBDC out into the economy, the convenience yield, which is the difference between the purple line and the green line is the opportunity cost, goes down. The marginal unit produces fewer liquidity benefits, and therefore the interest rate has to rise. Now, we do policy experiments, and first is a transition to CBDC from a steady state completely without CBDC to one with 30% of GDP worth of CBDC, which is overnight, for simplicity and transparency, put into circulation by buying back government debt from the market. And here are the headline figures for the results in our model. They are sensitive to calibration, but the calibration can very easily be changed, and then we can see how sensitive that is. It's a relatively large number, but I think even if you change the calibration in sensible ways, it will not be tremendously smaller. So it's 3% overall, roughly split between a 1% output, a steady state GDP increase because of lower interest rates, the second one because of lower fiscal tax rate, and the third one because of what I call lower liquidity tax rates. Let's go through that in more detail. The interest rates, the assumption is that CBDC is issued against government debt. CBDC is not defaultable, government debt is. So the stock of defaultable debt in circulation decreases, meaning lower default risk overall for somebody who looks at this government. And CBDC carries, and furthermore, a lower interest rate than the government debt because of the convenience yield. This is linked to the second point because a lower interest cost of government debt means more fiscal space. That means you can use seigniorage, and we're using it in the model to reduce distortionary taxes on capital, labor, and consumption. That also leads to output gains. Then liquidity tax rates. Modern money is mostly created by private banks. This is costly, as I already alluded to, for various reasons. CBDC can significantly reduce those costs, not eliminate them, but reduce those costs. Could eliminate them if it was a perfect substitute. And the result is therefore we would get greater money supply at reduced cost. Here is the simulation in the paper. Top left, CBDC over GDP rises by 30 percentage points. Next to it, privately held government debt to GDP drops by 30 percentage points. In the second row, we have GDP rising by 1.5%, almost on impact, and by 3% in the very, very long run. In those three circles, you see the three main reasons. Let me start at the bottom. Lower liquidity tax rates, that's basically putting more liquidity into the economy, thereby reducing those monetary wedges. Above that is lower fiscal tax rates, that's plowing the seigniorage into lower distortionary tax rates. And above that, we have lower interest rates, however, not on impact, because this is a long-lived transition to a higher output steady state that in the short run generates more demand than supply, thereby generates inflation, and the Taylor rule responds to that. So real interest rates, because they are ultimately arbitrage with the Taylor rule, follow that, and only in the long run there will be a decline. Now, that was the steady state transition. Now let's look at two scenarios for what happens once you're in a world with CBDC. One is, should we use quantity rules or price rules? And here we have a pool 1970 contractionary money demand shock. This is, people want to sit on their money. They want to hold more money that is safe, and they don't need to worry about it, and they don't want to spend it. What this means is we will have a combination of lower spending and more liquidity in the economy, which is what this chart shows. Now, we distinguish here between a quantity rule where we hold the quantity of CBDC fixed, that's the blue line, and the red dash, a dotted line, where we hold the interest rate at a fixed spread to the policy rate and let the quantity adjust. What you see at the bottom, if you follow the quantity rule, then the spread between the policy rate and the CBDC rate increases because the CBDC rate drops. Why does that drop? It's because people want more liquidity. CBDC is one type of liquidity. They are struggling to get hold of it, and they're willing to hold it at a lower interest rate than before. If you do the price rule instead and hold that interest rate fixed relative to the policy rate, then instead you will get an increase in the quantity of CBDC, and now as a central bank you're willing to release it as long as people offer you eligible assets. However, if you look at the top left, that's the GDP chart, you see that the difference between the two is not very large. And the pool effect is there in that the price rule or the interest rate rule has a slightly smaller contraction in output. However, it's only slightly because most of the additional demand and liquidity is satisfied by banks creating additional deposits through additional loans, which you see in the second row here. And that is almost the same between the two different scenarios. One caveat to this, if this is a generalized uncertainty type situation where not just households but also banks get nervous, so that banks do not want to lend to create the additional deposits, then you're much more in a pool type world. Then it matters much more how much CBDC the central bank is willing to release. And so the price rule in that situation, or the interest rate rule, would be significantly more advantageous than what it seems like in this scenario here. Next, countercyclical CBDC rules. Here we simulate a Cristiano Monterossano boom-bust credit cycle and look at countercyclical rules. So here we have 12 quarters of credit expansion on the part of the private banking system due to a Cristiano Monterossano risk shock, and then that whole thing goes into reverse. Banks not only face the same risk as before, but worse than before, and there's a sudden credit crunch that then gradually unwinds. This means that GDP increases, inflation increases in the top two charts, and then you see the policy rate on the bottom left, that's the solid line, following inflation as per the standard inflation forecast-based rule. Below that, you have the dashed black line, which would be if the CBDC interest rate was at a fixed margin under the policy rate. And what we're instead showing is that red line, where during the upswing, the CBDC rate increases, but by less than the policy rate, thereby increasing the opportunity cost of holding CBDC. Thereby, and you see that in the bottom right chart, taking CBDC out of the economy because people don't want it, because it becomes less attractive. And that helps to modify the upswing. And then later, when the downswing comes, it is made more attractive, more CBDC gets pumped into the economy, and that helps to buffer the shock. And here we see the chart for GDP, where the solid line is from the last chart, that's the fixed rule. The fixed rule from the last chart, and then the dashed line shows counter-cyclical rule, and the dotted line a very aggressively counter-cyclical rule. And you see that this is holding the Taylor rule constant and varying only the CBDC rule. And you see that this can, in principle, make a further contribution beyond the Taylor rule to smoothing the cycle in GDP by smoothing out the amount of purchasing power in the economy. Finally, financial stability and bank runs. This has been a main topic ever since we published this paper. The key is our proposed issuance arrangements, which are also detailed a bit more in a paper with Claire Noon that I published 2 years ago and has been updated a few times since. Those issuance arrangements would make deposits to CBDC runs very difficult in aggregate. There are two reasons for this. First, aggregate increases in CBDC demand do not affect bank deposits because the central bank only releases more CBDC against eligible assets, meaning government debt, meaning you cannot come to the central bank and write a check on your bank account and say, please give me CBDC in return. You can't do that today either for central bank money, so that's actually not radical. And because of this, in aggregate, the amount of CBDC cannot increase. And if it's just that two people exchange CBDC and bank deposits amongst themselves, somebody really wants CBDC, gets rid of his bank deposits, but he gets rid of them to somebody else in the economy, that means the amount of bank deposits in the economy does not change, and there is no run per se. There will be pricing implications of this, but not quantity implications to a first approximation on impact. Furthermore, policy rules can further discourage volatile CBDC.
2 minutes to wrap up. Okay,
how much?
2 minutes?
Yeah, that's fine.
Okay.
Furthermore, CBDC policy rules can discourage volatile CBDC demand. Under a quantity rule, I keep the supply fixed, the interest rate clears the market. So if there's a big increase in demand, as we saw in one of the earlier simulations, the interest rate on CBDC would go down. Maybe you have to stop at some negative rate, and then you'd have to stop there and say, this is now a price rule. Then the quantity would have to start clearing the market. Then you would have to get to a situation where literally the market runs out of government bonds. You could then still switch to other eligible assets. It's a question of, would the market really run out of eligible assets? And so ultimately this can still happen, but it's a much more extreme scenario than the naive partial equilibrium idea that, oh, people can, at the click of a button, get out of CBDC, get out of bank deposits and into CBDC. In aggregate, that's not possible. So here are the conclusions. On steady state efficiency, we found for the three reasons mentioned, there could be an increase in steady state GDP. The numbers we can talk about, but it's sizable. Business cycle stability, you would get a second policy instrument if you do it the way that we propose in this paper. Improved ability to stabilize inflation and the business cycle. Financial stability, CBDC should reduce many financial stability risks. They are listed in the paper. I didn't have time to talk about all that. It may introduce others if it is not well designed, but the main issue about well designed is that you want to eliminate the run, or mostly eliminate the run risk through the principles that I outlined in the last slide. The critical issue in my mind is the design of a smooth transition by getting the plumbing right. The hardware, the software, the legal issues, the regulatory issues, etc. And that's of course what all the central banks, or virtually all the central banks, are right now working on. And I conclude there. Thank you very much.
Thank you, Michael. Now we call James Chapman for his discussion. James, can you share the screen?
Yeah, let me just get it set up here. Bear with me. Okay, can you see my screen? Yep, awesome. Okay, thanks for inviting me to discuss this paper. I thought it was pretty interesting. Sorry, Michael, for changing the title of your paper in my discussion slide, but it didn't fit on my template. So before I start, I will say the usual disclaimers apply that, these are my views and not the views of the Bank of Canada. And with that, I'll start talking about this paper. So, we're having this conference because the costs and benefits of a widely available CBDC, they become a key topic in a lot of central bank discussions. And that's mainly for, I'd say, three main reasons. So first, there's a decline in cash usage. Second, we have new payment innovations like Bitcoin and crypto assets. And third, building on the first two is non-banks are starting to talk about issuing some sort of widely available digital currency. Classic example is Libra. So this paper is useful in that area because what the authors want to do is they develop and calibrate a sort of full-scale DSGE model of an economy, and then they have a central bank that issues central bank digital currency. And really their questions are all around the aggregate macro effects of a CBDC. So what effect does it have on the economy? And they make they've created the model to be very flexible to capture the many multiple channels that this effect could work through. So I only have 10 minutes, so I won't really go over the model because I think Michael did a pretty good job, and it's a large model as it is, but I'll say a few words here. So the model is based on previous work that Michael's done with some two co-authors, and really the DSG model has a lot of moving parts, right? So there's some households, there's financial investors, unions. I'll talk a little bit about the banks and the consolidated government because those are the key key moving parts in the model. And also there's a lot of rigidities and costs, right? So there's some sticky wages, sticky prices, hybrid persistence, which I didn't put up there, but investment adjustment costs. And then I think the key two areas that I want to focus on are these transaction costs, these liquidity taxes or liquidity costs, and also bank monitoring costs, which I think are another key rigidity that the CBDC can alleviate. So as in the presentation, there's banks, and banks, what they do is they basically issue money in this model in the form of deposits. There's like 4 different types of deposits for various things like consumption loans and mortgages and whatnot. And these loans are all differentiated for their usages and who gets them, but also their collateral. So there's all different collaterals, like land is a collateral for mortgages. The banks, and this is a crucial thing, they don't have any liquidity risk directly modeled in the system. So they have a transaction. This transaction cost is a stand-in for effectively a bank run. In that if people suddenly really don't want bank deposits, then the transaction cost goes up stochastically. And since putting this into the model will be even more complex, this sort of bank run risk, but to sort of proxy for the prudential regulation around bank risk, there's this effectively arbitrary minimum capital requirement with perfect monitoring that is put into the model. So basically the banks, if they go below a certain amount, they're going to get fined. So that fine has a real resource cost. Some of it comes back to the consumers by lump sum payments, but there's a real resource cost in that. So this causes this precautionary motive for banks to have a wedge between the borrow and lending rates and allows them to get some equity. But that wedge has got a real resource cost to it. So the way these banks work is, sort of to get some equity there. Now, the government part of it, and the way the government works is in the model is by targeting some debt ratio via government debt and distortionary taxations. And then in the pre-CBDC world, these government bonds are used in various areas, like with investors. And I think I'm not going to go over too much on this because I don't have a lot of time, but Michael made a good job with his presentation. In the post world, effectively what the central bank has done is issued some CBDC, The CBDC is then used by various members of the economy and effectively sort of substitutes for government bonds. And I think, and the key thing of the CBDC world is that these digital currencies also have a very low transaction tax to them, or transaction cost to them. And there is, while cash is in use, cash is in the economy as far as I can determine in the the way some of the rates are defined. So I'll just go over my comments then. So the first big comment is that there's a lot of frictions in the model, right? So the key punchline that the authors show is that introducing a CBDC on a reasonable transition path is going to increase GDP by almost 3%, and I think that's the key takeaway that we've been talking about this paper for the last 4 years when people talk about it, and that seems very large, and that's because in the model there's like many frictions that a CBDC reduces, right? So there's transaction frictions, which are essentially a tax on consumption. So CBDC dominates deposits there, so it reduces transaction frictions. Indirectly, it reduces the banking regulation frictions, and also it reduces debt held in private hands, which also causes the reduction in distortionary taxation, right? So the question I have is like two parts. What is which of these frictions is the one that matters the most? I mean, there is in the slides, you'll see there was a decomposition, but that's a decomposition for one type of CBDC. So that's a mixture of the CBDC's different parts, different aspects. And it's important because it's sort of saying, what the next question is, why can't the private sector do create this CBDC, or at least an easy transaction part? So by what I mean by what causes the central bank to, what causes the what causes the value of the CBDC to be so large, which is it, right? Because transaction costs, they both have a direct effect, and this is why they're CBDCs is just assumed to have a lower transaction cost in deposits, but why? Second, but then there's the indirect effect, because as you saw in the transaction cost, it's effectively proportional to velocity. So the CBDC in turn causes growth, which increases bank deposits, which reduces their frictions, if I'm reading it right. And then, for example, on the distortionary taxation, that's a straightforward reduction in distortionary taxation. And then the lower interest rates help investment in the economy, but also they're not fully passed through by banks, so that allows banks to pad their profits. And that what that does is that reduces their monitoring costs, right? So the reduction in the monitoring costs, expected monitoring costs, allows for like a lower resource cost in that area, that part of the economy. So given that there's all these things here, the flexibility of the DSG model allows for many different exercises. We saw that at the end of the talk and the end of the paper with quantity rules or price rules, different calibrations. But I think it also makes it kind of hard to understand what is driving the results a little clear at a fundamental level. And I'd say my other major comment is, where's the cash, essentially? In the model, sort of central banks have cash in CBDC, if I'm understanding it right. But in equilibrium, it seems like nobody uses cash as opposed to inside money. It's kind of hard for me to figure out even who's even holding the cash in the model, but someone must because it's valued. But more importantly, I think it doesn't seem realistic given that, for example, this Bagnall et al. Paper, Bank of Canada working paper, document that, in a cross-country survey, 40 to 80% of retail transactions are cash-based. So that seems like a very large section of the economy that is glossed over. And it's also important, since a natural question is what happens to cash in the model, because if you look at why central banks are increasingly nervous, there's the private sector component, which begs the question of why private sector can't create a CBDC. But the other one is the decline in cash usage. So it's very clear from from the writings of the Riksbank, also by our contingency plan that we unveiled in February, that the reduction in cash is front of mind for a lot of central banks. So not having a clear use of cash in the model, it makes it hard to understand what those are. I'm running out of time, so I'll just say on a positive note, I would say, since the model can be run many times, run it in a couple economies. One where CBDC has no interest, zero interest, but a really low transaction cost. That's a cash economy, maybe. And then look at the decomposition there. Do another one where the CBDC has a non-zero interest rate, but no transaction benefit. That's like a store of value government bond case. And that, for me, would give you a little better decomposition between the different possible uses of a CBDC, because I think that's where the mixture comes up. Because is it the means of payment part, or is it the store of value part that matters? And I'll say a very minor but good and fairly unique comment is this paper was written early on in this rapidly expanding literature. So when it was first published, there's virtually no papers on CBDC, so no real need to review the literature and put your place in it. But now there's multiple conferences a year on digital currencies. There's a lot of people writing these papers. A lot of people reference the author's paper. So I'd highly encourage them to revise the paper to respond to these folks in the literature and to show how their paper is related. So. And that comes from the fact that, it's a path-breaking paper. I think might be the first paper to model CBDC very formally. Definitely the first one to provide quantitative results, but there's other ones. Recent papers, Davut Hassani is an example. And also these quantitative results provide a needed counterweight to some central banker speeches, which were quite negative on a CBDC. Also, since it's so nice paper and it's an early paper, it provides many ways to forward for this research. Lots of ways to critique the model. That means there's a lot of papers to write. It's now a benchmark to compare against. In the end, I'll say I highly enjoyed reading it, learned a lot, and encourage others to read it. And with that, I'll turn it over to the Q&A section.
Thank you. Michael, do you want to start the Q&A by replying to James? We also have some questions after that.
Yeah. So nice discussion. Thank you very much. Which friction matters? That's of course a fair question, and we have obviously heard that question ever since we started presenting the paper. We have, however, not revised the paper significantly for a number of years now, and so I guess this is something that's going to come now. And so fair enough, but this is something that we do need to do and we want to do. Literature review is the same idea, right? We have the reason why there is no literature review with more recent papers in the paper is that we haven't revisited that section in a number of years. And we will now. Then you have a few details that I need to get back to. You had the low interest rates working through the banking system somehow and the profitability of banks. It's more than that in this paper because they basically, what also changes apart from spreads, it's also the risk-free rate itself that changes, or the policy rate itself, the real policy rate itself that changes as government debt is replaced by CBDC. So that obviously has a direct real effect on the optimal capital stock and therefore on output, etc. And that's a powerful direct effect that you get in any RBC model from the change in the real interest rate. You said quite a few things about cash. I would argue, in fact, we mentioned in the paper that we actually don't have it in the paper deliberately. You mentioned it has a significant share cross-section, especially, I guess, if you include developing economies. In terms of the number of transactions, if you restrict yourself to developed economies and the value of transactions, you get a lot less. And if you look at what share it constitutes of broad money balances, you typically get something like 3 or 4%. So that's also very little. Furthermore, I see the use of cash, the use case for cash, as a separable case, namely small transactions, etc., that you probably will, or some illicit transactions as well, that you will probably continue to use it for even after the introduction of CBDC. And our objective was actually to say, we think of this, the main competitor of CBDC, as bank deposits, not as cash. And I also wanted to stay away from that whole issue of negative interest rates and pushing cash out of circulation, because I think for various reasons that that's an awful idea. And so we actually don't say anything about cash, and very deliberately, because we think that it's the margin of deposits. And the thing is that if you mentioned the model is already not far from small, putting cash into this and having yet another margin, that's where we basically used Occam's razor. We didn't use it very much, but we used that. And basically we tried not to put that into the model in order to save some, because we didn't think it was the most important thing. The final question that you raised, why can't the private sector do this? There are a number of reasons for this that all have something to do with basically, I'm writing a paper with some legal scholars right now on money and what makes money money. And it's very much about the state versus the market theory of money that we're going to come out. And basically, the state theory just says that the state has some unique features that allow it to determine whether something is money or not. Whereas the private sector, if the state is not behind it and supports it with legal backup, etc., will have a hard time turning something into money. It would have to do this in a credible way, so that basically the private sector would have to create a medium of exchange that trades at one-to-one with something that is directly controlled by the state, right? That is something that is much easier to do for the state, both through policy, through regulations, through laws, than it is for the private sector. Furthermore, I think it's not desirable for the private sector to do this for various reasons, one of them being the seigniorage that can be collected in a non-distortionary way here. Just from a growing economy without inflation, you can generate seigniorage that can be used for fairly productive purposes in this. So there are reasons why the private sector cannot do this very well, and there are reasons why I think it should not do it. And I'll leave it there.
Thank you. Martin Summer raised his hand in the beginning of the talk. I'll allow him to ask his questions. Martin, are you still there? Okay, so yeah, seems like he's not there anymore. We have two questions in the Q&A right now. One is from Joe Roll. He's asking, like, treating retail CBDC like cash and wholesale CBDC version like cash, and the wholesale CBDC version like remunerated bank reserves cash would better approximate the ways in which central bank liabilities and base money function today. Has any modeling considering this approach?
So can I try to summarize that question, because I'm not sure I understand 100%. So basically he's arguing that there should be two different types of CBDC. One, a retail type, that's more like cash with a zero interest rate, and one, a wholesale type that's remunerated at the reserve rate.
Mm-hmm. Yeah, I think that's my understanding of the question. Yes.
Yeah, I mean, again, yes, you can make this model even more complicated, and I think that's an interesting question, very interesting question. However, the whole idea of giving general access to reserves at the reserve rate is something that we argued very strongly against in the paper with Claire Noon, because that potentially opens the door. Depends on the agents that you give access to, but if you make it fairly widespread access, it more and more opens the door for generalized runs on the banking system. Furthermore, you would then be, because if you give access at the interest rate on reserves, which right now is sort of the benchmark risk-free interest rate, in that world, that interest rate would become an interest rate on a type of money with potentially not a very high convenience yield if only wholesale agents have access to it, but still a convenience yield. So you're switching from controlling the risk-free real interest rate on a non-monetary instrument to controlling a monetary interest rate. And then the convenience yield, if it fluctuates with the market, would then determine what the actual risk-free real interest rate is. I think that would be a sea change for what monetary policy actually controls. And that is why in this paper, we're advocating that any interest rate on CBDC should have its own rate. And that the interest rate on reserves, which is what the banking system, which is relevant for the banking system and how it clears payments between banks, should remain the interest rate on reserves as it is today. That's something we can talk about, and it goes beyond the paper that I discussed today, but we advocate that.
So Jeremy Bennett has also a question. Jeremy, if you're still there, do you want to ask your question live? I allow you to speak. Okay, so it seems that he's not answering there. I'll ask his question. It seems that CBDC in this framework is basically QE, where the public holds to the created access reserves instead of the banks. Maybe we should consider the 3% impact to similar increase in QE, where excess reserves stay with the bank. It is the same 3%, and I'm not sure what is the difference with QE.
Yes, there's a big difference. First of all, if you give access, if you do QE, first of all, QE, if you ask a lot of senior central bankers, they're still thinking of it as something temporary, right? And not as something permanent. Whereas CBDC is something permanent. So that's one important distinction. Now, when you do QE, the way it's been done so far is that only the people who have an account at the central bank, only the agents that have access to an account at the central bank, can hold the liquidity created through QE, which is, in the UK context, roughly 200 institutions, not 60 million people, right? And those institutions have a convenience yield for wanting to hold that money. I'm pretty sure you can say that. But it is not nearly the same as the convenience yield of retail money. If you look at what the average discount of bank deposit interest rate is under a risk-free interest rate, it's somewhere between 100 and 200 basis points. Different people come up with different numbers, but it's not small numbers, right? So that kind of CBDC, that would be very different from QE, because you can issue it at this interest rate that is very significantly lower interest rate than before, and it would directly enter into the pockets of agents in the economy who have spending plans, investors, people who are just scraping by right now. You could even think about this being connected to the recent debate about universal basic income. You reach people very directly and then allow them to spend that money into the economy. Whereas if you do QE, you're always depending on how the banks pass this on. And if the banks decide, well, we're going to basically have these reserves sitting on our balance sheet, but we're not going to do anything to increase the amount of deposits. In fact, we might even do something offsetting, because when QE is first issued, that automatically leads to an increase in deposits. But what the banks then do with their overall lending policy determines what really happens to the overall stock of deposits. And if that doesn't increase, the money that is circulating between households and firms, people who really determine what's happening in the real economy, is not necessarily affected. So with CBDC, you do not depend on the agency of the banks to do what you want them to do, because you do it directly. With QE, you do depend on the banks. Thank you.
Thank you. It's Jeremy again. I really appreciate the answer, and I think I mostly agree with you. I mean, that means I think there's a question of commitment that's important, because you said QEs are temporary, but they feel like they're not anymore. And in your CBDC presentation, you also at some point mentioned that the quantity can go up or down. So so there's a little bit of commitment if you really want to make the CBDC like helicopter money, which I think is what you're saying. So I hear you. You want to keep it simple, so that's the case. But I think there's a commitment issue, and so again, so if you just did a QE with your toy model, what kind of GDP impact would you have?
If I did something whereby I said this QE is going to be permanent, contrary to what I hear around me, what I hear people around me saying, but if I just assume that, then there would be some effect through lower real interest rates. That's partial, because I wouldn't have any direct savings by way of a high convenience yield, but I would have the savings due to replacing defaultable debt with non-defaultable CBDC, which would have an effect. I would not necessarily, but then everything else that goes beyond that depends on what I assume the bank's response to this policy is. And I don't know that, right? I would have to make quite a few assumptions. So I think the effect would be stimulative, less stimulative than CBDC that goes directly into people's pockets. And the degree to which the two differ depends very crucially on what the banks do.
Thank you, Mike. I think now we are past due. We are officially in our coffee break. So we have 2 minutes to take a break. And of course, we can continue discussion. Martin had a question in the chat. Maybe he want to make the comment live. Martin?
Yeah, sure. Thank you, Bruno. Yeah, so basically, and I'm now reading from the chat myself. So the model, it seems to assume that the real rates are reduced if defaultable government debt is reduced. And here, defaultable government debt is defined as government debt that's not held by the central bank. And that having less defaultable government debt reduces real rates, even if the total amount of government debt remains the same, as you would have the case when you issue CBDC, where basically some of the defaultable government debt is now moved to the balance sheet of the central bank. However, I wasn't completely sure what would be the mechanism that would make the defaultable aspect of government debt be so crucial in driving the empirical negative relationship between the amount of government debt and real rates that has been documented in the literature. So I wondered, like, is there a certain theoretical literature that you're basically building on when you're making this assumption, or is it a mechanism in the model itself?
Very good question. I referred only to an empirical literature, and as you say, that leaves it a little bit open about where that empirical relationship between higher real interest rates and higher government debt comes from. I have, for that legal paper that I mentioned to you, done a literature survey, and there is a European Economic Review paper by Huixin Bi, who is at the Bank of Canada, or was, I don't know whether she's still there, who basically has that type of mechanism, 2012, and it basically, she documents that in various countries, the amount of government debt, or the rapid increase in government debt, was associated with ratings downgrades in various economies. And then she builds a theoretical model where this is the case. There's also a 2016 IMF Economic Review paper by Ricardo Reis, where he has inside the same model both a default possibility and an inflating the debt away possibility for government debt. And basically, when you have the higher the stock of government debt, the higher is the incentive to do one of the two. And he doesn't go quantitatively into which one is more likely, and he leaves that to a future literature. So there is a theoretical and an empirical literature out there, and it's on that basis that we did it. And in fact, when we chose the 2 basis points, elasticity, we deliberately chose the lower end of the empirical estimates that were presented in that empirical literature that we use to motivate this, so that we don't overemphasize this effect.
Okay.
Thank you.
Thanks, Michael. Thanks, Martin, for the question, everyone for the discussion. So now we'll move to the second paper. Bryan Routledge is going to talk about currency stability using blockchain technology. Go ahead and take it away, Bryan. Bryan, you're on mute.
I'm now unmuted. There we go.
Yeah, that's good.
Now you can see, let me just make that smaller. When I share my screen, it's like giant and overwhelming. So and then I make it smaller, and then it's more humble and feels a bit better. So thank you for the chance to present here. It's awesome. I'm sorry we're not all in person. I miss seeing people in person, but I can tell you that these chairs that we're living in now are really comfy, right? So there are some upsides to our little quarantine home that we live in now, where we are just living in, the comfort of my living room, and yet able to chat with all of you bright people. Give me 1 second. Let's just call up the chat here. I can't see you, and it was throwing me off. It's good to know there are people out there when you're talking. All right, thank you. This paper is joint with Ariel, Zetlin-Jones. The other weird thing about conferences now is you have co-authors in the audience, so it makes it a little harder to free form and make up results on the fly because they tend to correct you, but we'll see if we can get through it okay. So this paper is looking at using blockchain to think about currency stability, and blockchain, the need for currency stability comes from blockchain itself. So every time someone does an ICO or starts a new blockchain-based business, there is an ICO done where they sell some new currency. And the currency either looks like money in the sense that its purpose is to be used as a medium of exchange, whether or not it's successful or not is to be determined, or it's some kind of utility token you have in mind. So if you want a sort of running example for what we have in mind here, you can think of Bitcoin or Ethereum or the big currencies, but imagine we're sort of doing just a little ICO. Ariel and I have a business for, I don't know, CMU coin, crypto peg token, where we're going to sell these tokens, and they're good for some services on the blockchain that come later. And you are buying these tokens and you think you might use them later, but there's a ton of uncertainty in this, and so you might like to redeem them. And so all of these sort of new coins that have popped up has sort of brought new interest in currency stability. And so can we sort of use some theory and then mash it up with what's available on the blockchain to see if it works? All right, so let me see if I can press on with that. Okay, so here's the fact that my guess everybody knows, which is cryptocurrency prices are wildly unstable. The thing that makes them look the least like money is they're really volatile. They're volatile relative to exchange rates. They're volatile relative to, if you include the price of gold. Sorry, I'm probably in the way. They're volatile if you include even relative to the S&P 500. So that's sort of volatile relative to any sort of money like. Even notice the spike up in the pandemic spike in volatility in, I think it's March of 2020. There's also a spike in Bitcoin volatility at the same time. So a humorous aside, it is way easier to buy a throw pillow with Bitcoin on it than it is to use Bitcoin to buy something. So Bitgear, this website, will sell you all kinds of Bitcoin things, but only if you have a credit card that's paying them in US dollars. So it's yet to become a medium of exchange for all kinds of interesting reasons. There are, of course, some stable coins that have been designed to try and use something like a currency policy. So Tether, I think, is the most famous of it. And it claims every Tether is 100% backed by, a US dollar. There's a vault somewhere that Tether has that is storing some money like assets. It turns out 2 years ago, I think the New York Attorney General's office indicted Tether and Bitfinex, and it turns out that some of those assets that are backing your Tether are a loan to their sister company's crypto exchange. That's a still outstanding one. I created an example for a class once thinking about, let's imagine a banana coin. And then I thought, oh, before I do that, turns out there is a banana coin. So this particular coin, I don't think it ever quite got off the ground, ever ripened. Maybe that's the right, too bad a pun. But they're planning on tying the price of their banana coin to the little tiny bananas known as a ladyfinger. The things you learn on the internet are spectacular. So I Googled them yesterday. They are still struggling to get their ICO up and running. So these currencies are clearly risky currencies. These tokens, these coins, whatever you want to call them, are clearly risky for fundamental reasons. When you buy a token on Ariel and I's speculative blockchain, its future value is unknown. It is certainly a random variable to you. Whether or not our service is valuable to the world or valuable to you is unknown. But they're also volatile for just old-fashioned speculative reasons, in the sense that people trade them. Perhaps some irony, perhaps some deep economics, but the biggest single use of Bitcoin I know of is to place it on a centralized exchange and trade against it, right? So lots of the big exchanges like Coinbase, Coinbase, or BitMEX, they're all sort of speculative trading on Bitcoin. So here's what we're going to try and do in this paper is we're going to borrow from the banking literature to give us a new theory of currency stability. And what we're going to do is have a currency peg that's going to have basically a gradual, it's going to react dynamically to trading. And we're going to design it in a way to be immune to these speculative attacks. And that's agnostic to blockchain. That's just a thing about currencies. The reason it's sort of interesting for blockchain is to try and think about implementation. And so to implement this, we're going to use the smart contracts on the Ethereum network. So these are, instead of just exchanging tokens, this is a blockchain that exchanges code. And so we're going to be able to sort of credibly commit to this complex policy, stick on a blockchain. And then here's the cool thing is we have taken a perfectly fine theorist, and now Ariel has a GitHub page. So you can go to our GitHub repository. How often can you say this in a talk? You can go to our GitHub repository, download our code, and it will implement this protocol on an Ethereum test network. And I will show you that later. If you want all the details, there's even a video that lives there. So that's what we have done with our summer. Is that a little bit. Okay, so this list is embarrassingly short. There's way more papers here than I need to be citing. But what we're basically going to do is take one of these kind of standard canonical exchange rate models, where what we're thinking about is, instead of a foreign currency, we're thinking of one of these coins that's been issued, and we're going to look at building a policy to stabilize that by using borrowing from the sort of banking suspension of convertibility literature, particularly this Green and Lin paper of 2003. And then we're going to see if we can sort of develop some stable coin. And then that's a list of stable coins, some of which may come and go. I'm sure it's probably out of date since that changes pretty quickly. All right, so here is the gist of the model, and I'll try and see if I can get through this. So my guess is lots of it should be familiar. It is a relatively standard currency attack-like model. And it'll also sound a lot like, you know, the Diamond-Didvig banking models. So think about everybody here buying into our ICO. Ariel and I should have actually done this. We could have marketed to you and actually raised our money during the talk. But imagine you have all bought one of our crypto bag coins, and you bought it with the anticipation that you might use this service. And if so, we're going to call you a crypto type, and that's going to have, you are crypto types with probability mu crypto. The fundamental uncertainty is going to be that the mu crypto is not one. Lots of you might not want to use this coin for what it's intended. And essentially, at the beginning of the period, you have one. At the end of the period, you're just happy to eat it. So our crypto people just eat the crypto coin. Some of you are going to say, what the heck was I thinking? Why did I buy this? I need actual money because I need to go buy something real, not services on this blockchain. And so here with probability mu dollar, 1 minus mu crypto, you're a dollar type and you want to convert this coin, crypto coin, back to a dollar. And what we would like to do is have a protocol that helps insure you so that you get your dollar back, which presumably might help you incentivize you to buy into our ICO in the first place. Okay, the thing that makes it challenging to design a currency peg, of course, is that all of you crypto types have the option to sell the coin at, say, the beginning of the period, repurchase it at the end of the period. So if the price has gone from $1 to 50 cents, you can sell it and end up at the end of the period with twice as many crypto coins, twice as many services on our blockchain. And then tau is a small transaction cost, which means if the exchange rate is going to decline noticeably, all of you crypto traders might want to sell your coin. All right, so here's the idea, is we're going to take our dollars, which is going to be less than 1 for 1, and we want to design a policy that will try and avoid these speculative attacks, so that will be a equilibrium where all of the crypto traders will hang on to their crypto coins. The people who turn out to be dollar traders will sell their dollar traders, and will allocate these R dollars to the appropriate folks who need the liquidity, the conversion back to dollars. So the 3 state variable to keep track of is there's going to be sort of capital J people in our model, 100, I don't know, 3 in one example, 100 in another. Keep track of how many we've seen so far. That's going to be little j. Of the people we've seen so far, some of those will be crypto types. So state variables of the people we've seen, how many are crypto types, how many are dollar types, and then how much of the reserves do I have remaining? Okay, the standard sort of currency peg story that does not work is a currency policy that is, I call it unconditional, with some, informally think of this as unconditional, which is I'm going to support the peg with my R dollars, which is anybody who wants to exchange. I will give you E-bar, and I'll do that as long as I have some reserves left. Once my reserves run out, this crypto coin floats. And to make this problem interesting, imagine that floating rate is small. I don't know, 0 just for sake. You can see that this is, that there will be an equilibrium in this model where all of us crypto types speculate that everybody out there who has one of these crypto coins is likely to sell and try and receive E-bar. And if all of our crypto types sell and receive some fraction of E-bar with some probability, the exchange rate falls, and indeed you have one of these self-fulfilling currency attacks. Okay, so instead of that, think of the J traders in a line. So this is borrowing on Green Lynn where there's a bank run, but people are in a line. So we're going to put our traders in a line. If you're thinking, how are you going to put your traders in a line? We're going to do this in our code later, in part because we code it. We can literally put them in a line. So imagine we're going to be a queue and we're going to serve them sequentially, and we're going to solve this dynamic program. So all my traders are in a line. So the central banker, the social planner, is solving for this value function. which is what I'm going to do is design a sequence, a strategy, a policy function for conversion rates for trader 1, 2, 3, conditional on what's happened so far. And essentially what I want to maximize is if you are a dollar type, I see those with probability mu, I'm going to hand you this E0J. I'm going to exchange your crypto, take back your crypto and hand you E0J dollars in return. Notice in the value function, just watch the update. The number of crypto traders does not update because you were a dollar type. That's the theta. And then notice my stock of reserves goes down as I hand them to you. The other thing that might happen is you are a crypto type, in which case you trade 0. And my reserves do not go down, but the number of crypto traders goes up. This is what we're going to want to solve. And then the constraint on this problem, this is in a specific example where folks are risk neutral and this little lambda parameter we have has gone to 1. It makes it for an easy case. It's a bit more general in the paper. Is I want to make sure that at every point I want to be subject to this sort of no speculation constraint. So trader J, I'm going to offer them an exchange rate. And then that E1, that exchange rate that happens at the end of the period, that's the random variable. If that's going to go down, you're going to speculate. So I'm going to have to solve this subject to that constraint. Okay, let me move on so I can get to the cool bits. So there's a proposition in the paper that works through a detailed case. So we do all the algebra with 3 traders and you get roughly, it's a cool bit of results. You get sort of things that are appealing, which is the amount of reserves you need is smaller when the fundamental uncertainty is smaller. So if all of you crypto types are for certain going to be crypto types, I need fewer reserves. If the transaction cost is really big, I need fewer reserves. So this works out a bound on how many reserves I need. Here's sort of an example that we can go through, which is more picture driven, which is let's do a policy with 100 people, and I'll show you a picture. Here's the first one I want to highlight is the optimal policy is dynamic. So what you're seeing here is that thick black line is the average redemption rate over the period. So on average, my exchange rate kind of just doesn't move so much. This is simulation, so the wiggles are some simulation. There's some error bound, there's some 1 and 2 standard deviation bounds around that, which is, since there is fundamental uncertainty, the number of these 100 traders that are crypto or dollar types will vary, my exchange rate moves. Those goofy bounds at the very outside are in the unlikely case that everybody comes, requests the dollar, or everybody that comes says they're crypto types. So it's that range. And what you can see in the sense that the policy is dynamic is we can run just a little experiment where I take 5 traders in a row and make them either crypto or dollar types. The dollar types, the exchange rate drops. That's the red line on the bottom. If you are crypto types, the exchange rate goes up a little bit because that's good news for the amount of reserves I have left. Notice those lines are flat as you go across. That's the no speculation constraint showing up in the simulation. As you move that shock through, let me move it way out to the end. Notice that it has a bigger impact as I get close to the end. When I get close to the end, I have far less uncertainty remaining. When I know that trader 95 needs $1, I only have to worry about the remaining 5 traders. So my reaction to trader 95 being a dollar type is stronger. Okay, the second one is the policy is immune to speculative attacks. This sort of works with backward induction. So the idea idea is I'm going to speculate that I'm going to conjecture that everybody behind me, trades after me, will indeed request their dollar. So if we did that, and suppose, I don't know, say the first 35 traders requested their dollar, it's a black line written on the bottom. Look at trader 36. 36 has no incentive to request $1 because the exchange rate's not going to fall any further, and they're just going to get eaten by a transaction cost. So they're going to choose not to speculate. Roll that dominant strategy back. So if trader 35 doesn't, trader 25 is not going to speculate. Trader 25 doesn't speculate, neither is trader 15, and you're right back to no speculation. So that's kind of cool. Okay, now the last thing I want to show you, we're packing a lot in here. I appreciate that. So deep breath. Okay, the last thing I want to show you is this is complicated and there's a lot of moving pieces. And what you're thinking is, it's hard enough to convince people, what's the Taylor rule? And we're going to tie ourselves to the Taylor rule. Imagine tying ourselves to this very complicated dynamic programming problem. Here is blockchain technology, which is going to let us do that. So here is our code. So let me show you how this works. There's like a really long, either interesting or boring video, depending on your perspective, that we put together with all of these steps. So watch it if you like. But this is Ariel's GitHub page that downloads the code. It's not that complicated. It's about 4 or 5 files. Here's the steps. Okay, so what we're going to do is we're going to imagine doing an ICO. Let me describe it here. So we're going to describe it here. We're going to do an ICO, and then we're going to have people trade our coins. Sorry, do an ICO, people are going to buy our coins, and then we're going to implement this policy and see how it works to stabilize prices. Okay, so before you want to code in Ethereum, you need to get an Ethereum test bed, because you don't want to spend real money coding, because you're going to make all kinds of bugs and you don't want to spend hundreds of dollars on real Ethereum. Fortunately, you can download a program called Ganache, which lets you run a test Ethereum network right here on my computer. So this is living a little local network. It's simulating everything that happens on the Ethereum network. Folks are mining. It's got little miners in there that are gathering the transactions, listening. And the nice thing is it gives you a couple of accounts to play with. So Alice is going to be our central banker. She's the one that's going to do the ICO, implement this policy. And then we're going to have Bob, Charlie, and Donna. These 3 accounts are going to trade. So we can follow what happens in these 3 accounts, because all of this happens here. All right. So here is, on the right there is a chunk of Ariel's code that he wrote up. It's written in this language called Solidity. It's sort of looks like Java, but it's a bit more picky because it's got to run on every computer in the world. So Solidity has that extra challenge. If I want all kinds of computers to compute this, they all have to come to the same answer. So the first step we're going to do is compile this code. So we compile it, off we go. Then we do our ICO. And doing our ICO is under that word deploy in the lower left there. And what we're doing when we deploy, sorry, I can probably point along here. Oops. That bit down there. Oop, come on. Ironically, technology is failing me. There you go. I give up. Okay. There. We are setting the parameters of our code. So we're going to issue 30 coins. That's its name. This is a relatively easy step. Solidity has sort of a built-in feature for here's how you issue a coin. It's solved lots of these technology issues you can imagine about how do you transfer it, who owns it. So it's relatively easy to call this type. Off we go. We send that there. We compile it and we stick it on the blockchain. And the compiled code you can read on the blockchain. So one of the things you can do credibly is I can publish this code. It's on Ariel's GitHub page. You can take it, copy it into Ethereum's little compiler, see the bytecode that's out, and indeed verify bit by bit that what is on the blockchain is what Ariel told you is on the blockchain. So our policy is credible in the sense of you can read it. Every digit of the code, you can verify we have put it up here. The other thing to note is this contract has a little address that'll come up in a second. So Bob goes through. We're going to have Bob, Charlie, and Alice. We got a little rudimentary web page for them. They're going to go buy the coin. This is our ICO stage. They have bought 10 coins using some 9 Ethereum. So this happens for Bob, Charlie, and Alice. They go do that. This all happening sort of pre-early our model. Alice then takes those coins. Alice had transferred those coins. Sorry, notice those coins, that money that Bob, Charlie, and Donna sold. So their Ethereum balance went from 100 to 91. Those 27 Ethereum did not go to Alice. Those are living on that contract. So those are out of Alice's hands. That's the 27 that's going to support our price. And a side that's interesting, notice Alice, her contract price has gone down, her Ethereum balance has gone down a bit. It's gone down because she spent some transaction cost. Publishing complicated code is moderately expensive. Okay, now there's a whole bunch of design choices. There's a whole bunch of design choices that were built into our model that you may or may not have arguments and questions about. We put people into an order. Is your order, do you know where you are in line? Do I know where other people are in line? Right? These are all sort of design choices. So here, we made this public information. So you can poll this particular contract. You can see who trader 1, 2, and 3 is. It has told you trader 1, 2, and 3 in their public key address, but you know your public key address, so you know exactly where you are in line. You don't like this, you'd like it to be somewhere different where this is kind of noisy information. With some more work, we could do that. Okay, now the next thing that Alice needs to do, the step that is important here in the credibility step, is Alice is now going to basically pass off ownership of this contract back to the contract itself. So this is how you do credibility. You know, think about rules versus discretion. This is how you do rules. Alice transfers the ownership of this contract to the contract itself. And now everything that happens going forward can only happen based on that code. There is no discretion. That contract has no free will. It can't do anything on its own. So if you send coins to a contract and forget a function that says, please send them back, those coins are lost, which is definitely why you want to test it out on your Ethereum network before you do it for real. So this peg policy, run peg was the little command that we've done. Once this is live, our model's now live. I'll wrap up in 2 seconds here. Our model's now live and our traders are in order. Bob is our first trader. And so Bob is our first trader. He can check that indeed it is now his turn to trade. So his account is no longer frozen. This was a ham-fisted way for us to do it. We froze and unfroze accounts. And he can ping the contract to see that if he wants, if he is one of these dollar types, he can sell his coins back for $1. And Bob says, yep, that's me. I am of type D. So he's going to sell his coins. So Bob sells his coins. That's the first step. Now we go to Charlie. Charlie is now unfrozen. Charlie has the opportunity to trade. Charlie pings the contract to see what the trade price is. In this little hacked out example in our Solidity code, the price has fallen. That's the dynamic adjustment of the price. Since I've seen one person who redeems, I'm now willing to redeem your crypto peg coins at a lower amount. The peg is adaptively reacting to the fact that I've seen $1 type trader. That after that, in our particular example here, let's imagine Charlie said, no, I'm a crypto trader. I'm happy to hang on to my crypto trading. He also is doing that. Do I want to speculate? He could speculate if he wants to, but he's read the code. He knows there is no value to speculating because there's no value to speculating because the price would just fall. He's done that backward induction. Okay. So last thing is now you go look at Donna, and Donna can ping the trade, and she's now able to trade, and she can ask the price, and now notice the price has gone back up. It's gone back up because it's now seen $1 type, one crypto type, and do the backward induction with the parameters in that particular example, and the price goes back up. Here it happened to go back up to 1, and now she could sell or not sell. She ends up selling. So that this is sort of a quick abbreviation for this code you can download and run inside of this little environment. There's a few moving pieces inside this environment ganache, and what you can see is that Alice is uninvolved. Once she deployed the contract and ran the crypto peg, she knows no longer more control over it, so she just spent her nickel's worth of Ethereum on the transaction cost as it done. And Bob bought some of this contract and redeemed it because he was a dollar type. Donna bought some of this contract and redeemed it. In this particular example, they happened to make a small profit. Charlie decided to hang on to his crypto peg coin, so his Ethereum balance is lower, but his crypto peg balance is higher. Right? So soup to nuts. So that's the ping the working code demo, get it working. There's a whole video that we put together using our, we're all experts on Camtasia and asynchronous learning, so why not? There you go. Download that. And I think the sort of interesting thing to step back before I wrap up here is there's a bunch of sort of issues that are interesting to ponder from here. One is we supported this crypto-pegged coin with Ethereum that was all living on one blockchain. That was easier. If I wanted to support my crypto-pegged coin with dollars, how do I do that? That's more work. And so what I might need to do is I might need to sort of create some other coin that's somehow maybe one-to-one backed. Can I take advantage of the new rules of, I don't know, that the banks can now be custodians of cryptocurrency? Can I do something like that to make it a two-step? That seems like an open but solvable question. And then I think the thing that is most interesting is all the variations on the model that you think are better, worse, or want to try. These are things you can literally code in, right? Maybe Ariel and I can't do it because we're not good enough Solidity coders, but we know a guy, right? Here's the environment you think is going to work. How do we sort of create that information structure? We can stick that in, and I think that's sort of the real appeal. So let me wrap up. I think I'm either close to time or out of time, depending on your perspective. So there's a nice cycle here. Blockchain has spawned all these new coins. It spawned all this new interest in currency stability. So what we've done is borrowed some little banking theory to see if we can generate some currency stability. That theory is agnostic to cryptocurrency, but I think what's really interesting is that the blockchains that have spawned all this also offer a tool for solving some of this, which is using these smart contracts for implementing the complex and credible policies. All right. I will wrap up there and then we can hear Bruno's discussion.
Okay.
Thank you all.
Thanks very much, Brian. So Bruno is the discussant. You want to go ahead and share your screen, Bruno?
Unmute, Bruno. You were on mute. There you go.
Okay. Now can you hear me?
Yes.
Okay. Thank you everybody for being here, and thank you for the invitation, Todd and Jonathan. This is a very, very nice paper, and I think I learned a lot. And I think everybody should take a look. It's a lot to learn. So what is the basic idea? Well, I mean, you saw it. There is a lot of volatility in cryptocurrency. And then you want to do some peg type of, so you imagine someone would want to do some type of peg policy to stabilize it. This is a common solution. We have been talking about this for decades now. So Brazil have done it. I'm from Brazil, so I kind of know details of the case. And it's this makes you subject to speculative attacks. So unless you are 100% backed by the reserves, you really cannot, you really are vulnerable to that, or at least we think it's a risk. Okay. So what the authors try is like they show a model and that have a lot of similarities to a bank run type of model, and they build on Greenlee type of approach of preventing bank runs. So I want to step back and say why cryptocurrencies. We could do the same thing. Brazil could have done the same thing in the 90s, or Mexico could have done it. So why we are talking about cryptocurrencies? The first one is like probably commitment. So this is in the context of bank runs, and is Roberto and Todd has this paper how to show the importance of commitments to prevent bank runs in several models, and the blockchain just allows you to commit, right? It's as Brian was made very clear. You send the ownership to the contract, and you're done. You cannot undo it. So the second is more practical. Like if you talk with people about, especially why people use simple contracts for banks. There's a lot of like Diamond Divisible type of model. Yeah, we assume simple contracts. And you talk with people, they say, well, like all this complicated models that people put with like contracts going down, payments keep going down over time as people withdraw. It's just too complex for a real implementation of like to ask that a bank is gonna do that. And then they rely on simple contracts, right? There's like a simple payment rule. And maybe in a blockchain, this is just kind of easy to overcome. You can just code whatever smart contract you want, as long as you have someone that's, it's a really, really good programmer. And I don't know a guy, but I can ask Bryan, who's his guy. So let's just recap the model pretty fast. It's kind of similar to all this type of diamond dynamic models with discrete number of agents. So you have a crypto guy that really like the cryptocurrency. Then there's a guy that may like dollars, and there's some probability. And you think about the guy that likes dollars as our impatient type as a bank model. Okay, and the guy that likes cryptos, there's just guy that likes to hold it. So it's the patient guy. Then you need to establish a payment. Payments has some like resource constraints. So there is some reserves. You go paying as people arrive at the contract, not at the bank, but at the contract, and the contract goes giving the reserves as people ask for it. And there is some adjustment. And then you have incentive compatibility constraint that's for each like J. So it's interesting here. We'll go back about this. It's for the information, the incentive compatibility one for each investor J, or J is his sequence in the queue, for each information set that can arrive to him. So if I'm the third guy, the information set that arrives to me is what was the actions of the previous two. So if I'm the fifth guy, it's what's the action of the previous four. So you have a lot of incentive compatibility constraints. So you can think about that. Okay, and then you maximize welfare subject to these constraints, and then there'll be some parameter restrictions that you have that the optimal allocation is incentive compatible, and it's actually the unique equilibrium, and the logic follows some form of backward induction combined with some idea that the currency has to kind of cannot devaluate over time. Okay, so this is just a review, and like I'll just talk about a little about what I think is kind of two things that I think is nice that we should be thinking about. One is the information structure. Okay, so this is a definition of smart contracts from Kong and Hayes. I think it's a very nice way. I think it's a review of financial studies, something like that. They define smart contracts are digital contracts allowing terms contingent on decentralized consensus and not tamper-proof and typically self-enforcing. I want like this consensus because this gives like these contracts generate complete information. And for this particular paper using Grelin, you want to have complete information of what happened before you, so you can do the backward induction. But that can reduce welfare. In the context of their paper, Kong and He, what they build in Green Porter, which show how collusion can happen under private information. But the way they build on it is that once you allow for decentralized consensus and everybody knows everything, it can help agents to punish deviations, which means that we can collude better. So if you want to, if you want to like support, say, a monopolistic price, and I can see that Todd is actually deviating from that, I can go to a price war with him because I can see. And under private information cannot do that, which means that once prices are open in the blockchain, it makes it easier for us to collude because you kind of monitor each other. So there is this aspect of blockchain that I think this paper push, like in this particular context, but in general, the information structure matters. So one thing that the authors push as an advantage of the blockchain is that the contract is there, we all can read, we all can see what happened, but like the particular parameterization of the model, it's fine, but you can put preference shocks and things like that, where as you're saying, like you have a lot of incentive compatibility constraints. And if you have some of the incentive compatibility constraints now bind because you have a lot of information, you're going to reduce welfare. So this is a welfare decreasing implementation. So that's kind of something that when you talk about all the information structure in the blockchain, it can be a negative aspect of it. I will also take 10 seconds to say that the green importer here is the same green of Green and Lin, and this month it's kind of 1 year that we lost him. And it's not coincidence that both papers in this talk, like he was just super smart and he influenced the profession amazingly, and kind of nice to be able to go back and look at some of his papers. Okay, so that's one. The second thing that I want to talk about is that a lot of the discussion on CBDC goes around the currency itself. But I think I went through the program, like I don't think there was many papers talk about the potential of smart contracts. And some of these things came up, like, well, how you do peg if you don't have dollars? So are you gonna peg to dollar? Well, the way it is now, you cannot, because dollar is not a CBDC, right? Now, maybe what you wanna do is have a CBDC just so people can write smart contracts on US dollars, right? So you should, like, we should take seriously how many possibilities are open by the CBDC. And one thing, like, and I wrote here some things that we can think about. One is like government bonds. The government is just a smart contract. It can be implemented as a smart contract. It's just transfers US dollars. If US dollars are a digital currency, it's just kind of a smart contract out there. Okay, and like you can think also about sophisticated QE policies, balance sheet reductions, reverse repos. Everything can be written in one. Once you have a script, that's obvious, but not only that, but maybe you want to commit that between two FOMCs, you want to have a policy running, and you definitely don't want to have a FOMC meeting every 2 hours. So maybe you just kind of write the script and say, hey, for this meeting to the next, this is script that's going to be running, and just let it there. So there are advantages of maybe potential of doing that. That's not really this is not related to the CBDC itself. It's just allowed by the fact that we have a CBDC. And from the private side, once you have the digital currency, they can build these other type of contracts, right? Like if someone wants to create a digital currency that's pegged to US dollar, it's easier because it's within the network. So all these things like becomes kind of easier. And then if treasuries are just a smart contract, then you can always like transact this much easier. So Daryl Duff has a recent paper about how we can have central clearing for treasuries, and that can have some benefits. If everything is the same network, it would make much easier to centrally clear everything. So all this there's all these possibilities. And this is not science fiction. Bank of Thailand has done both CBDC and bond issuance. Okay. And so, yeah, so that was basically what I have to say for discussion. This is a very nice paper. Showcase one application. I think there are several. I think this paper can be like first of many that try to explore these benefits of CBDC. There is also a service to the profession that's kind of like Bryan was talking about. There's the online video. There's the GitHub repository. It's just kind of, you just want to learn how to do it, even if you don't care about the paper. That's kind of a great way to start because it's more familiar language for us. There are a lot of potential benefits come from smart contracts. There is this thing that we need to start thinking about. The blockchain requires more information, and information can be welfare reducing, can be welfare improvement too, but we should be thinking about many papers in the workshop that talk about information. So I will be happy to learn a lot more about that. Thank you.
Okay, thanks very much, Bruno. Bryan, do you want to take just a couple of minutes to reply? And then we've got some interesting questions in the chat box. I'll ask the authors of those questions to ask them.
Yeah, I'll be brief in my reply, Bruno. Thank you. That was hitting on lots of important points. The one I would like to peg, I think, is underappreciated. Is I think governments linking to blockchain to make things like dollars tokenizable and make them real things on blockchain, I think is something that is underappreciated. That I think that sort of ties into a network that's really interesting. Whether or not it's good, bad, or indifferent, I think requires a lot more work and thought, but I think that's a really good point. And I think lots of your other comments are good as well, but let me turn to the questions so we have time for those.
Okay, Charlie, do you want to ask your question about sequential service?
Sure. Yeah, this is cool stuff, but all that the sequential service constraints seem to be pretty tight in the story, and that's coming from the history of this stuff. But you've got such a powerful mechanism here that sequential service isn't an issue for you anymore. You can build any rule you want to into it. So wouldn't it be useful in your structure to let people get some of their money back conditional on what happens after them in line?
Yeah, yes. I mean, I think that you're exactly right in the sense that inside this code, it's just if-then statements. And so it's relatively easy. Sorry, it's relatively easy for Ariel to code it. I'll put it on him, right? In the sense of, yeah, it's exactly that. Let me just restate what you said, which is the fact it's just computer code opens you up to like a whole new way of thinking about this. I do not have to worry about people at line in a bank. I can put them in any order I like. And I think that opens up a lot of really interesting options. Yeah, that's a really good point.
Yeah. Okay, Jonathan, do you want to ask your question?
Thank you. I think Bryan has already briefly mentioned this issue, right, in the conclusion, that for the smart contract to work, right, we need to kind of assume the pre-existence of this tokenized reserve dollar already on the ledger, right? But if this is not the case, if there's no tokenized US dollars, so it's not clear how we can use this smart contract to create the first stable coin, right? And if it does exist, then we already have a stable coin.
I mean, I think you're right in the sense that, I mean, the broad point is when you read blockchains and, oh my God, blockchains are going to save the world. It's the greatest thing since, I don't know, sliced bread. The big friction of where the blockchain meets the world is almost always where, you know, there's a blockchain that has, I don't know, house registry, or it determines whether or not assets could be pledged. At some point, you need the county sheriff to show up and say, you don't live here anymore because you haven't paid your mortgage. That's not part of the blockchain. And here, what you're seeing is basically how do you take a fistful of dollars and credibly connect it to a blockchain, I think is a huge issue. In our paper, what we have done is thought about, can I take, you know, Ariel and Bryan's goofy coin idea and tie it to Ethereum? And Ethereum is still quite volatile, but that's no small feat in the sense of we've taken our little wonky coin, to which you should be quite leery of because we might not know what we're doing, and have tied it to Ethereum. That is a useful step. And I think being able to sort of solve some of the legal structure of how you would do this with real assets, and lots of people have tried, right? There's a whole bunch of stable coin out there like Tether and, you know, the stuff that Libra has in mind. There's lots of people poking at it.
Okay. And Will, do you have a long question there in the chat? Do you want to ask that?
Yeah, thank you. Yeah, I really enjoyed the presentation, and it's super cool to see that's being implemented. So I have two remarks / question. I have to qualify that they are mostly coming from kind of thinking about platform tokens, right? Where tokens are associated with certain functions of platform. But here I understand it's more for general payment. So the first one is really about, do we need to think about endogenous adoption? You know, people may not all have switched to the digital currency, and that could affect the volatility of token or cryptocurrency returns. So that's number one. Number two is just a remark on the functionality that blockchain brings. One thing we can do is burning token. I guess that's the equivalent to government buying back fiat money and just shred them. Is that going to help with the policy here? Is that going to enlarge the design space, or the current design space is already kind of globally optimal, even as a subset of the bigger design space?
Let me take those in reverse order. So what he means by burning tokens, by the way, is you can take tokens and just send them to an address, like a contract address that has no way of getting them back. And so that's the sort of credible way of making the money supply smaller. Same with, you can leave in the contract the ability to make more coins. The coolest sort of example of burning and creating coins is sort of creating something like an ETF of crypto coins. That step of sort of how you match, I want to create a token that matches this basket of currencies, will involve that sort of creating and destroying of coins is really interesting. That's all aside from the deeper question of, does that help or hurt my goal of trying to create a more stable coin? And I don't know off the course. So what we had in mind was, we are standing back ready to buy back those coins that you were sending. And so we were focused on, this stable real currency that we had in mind that we were supporting it with. We didn't really think carefully about the supply of tokens. That I think is a good one. And then the second question you asked about is this sort of more general point as to what is a coin, in the sense, so the SEC and regulators have made this distinction between some coins are financial security like, in the sense that they look like money or they give you some sort of equity claim, or some coins are utility like, in the sense that they give you some service on the blockchain. And I think our perspective is these things are all real similar. And so if I am selling to you, you're looking to buy into my speculative service, particularly if it has some sort of, it's only valuable if lots of people join, right? That kind of network externality. Being able to offer you a credible way of saying, I will give you your money back if you don't like it, is, we don't normally think about pegged policies as money back guarantees, but that's roughly one way to sort of think about it. And I think in the sort of IO literature, what does that add in terms of building, if you're building one of these models that got these network externalities and you can offer a money back guarantee in some sort of credible way, does that change the nature of the game? That seems like a really interesting question.
Thank you.
Okay, we've got one question in the Q&A box from Amani, who says, I'd like to clarify that Tether has explicitly stated they are not fully back since March, April of last year. This announcement was met with no noticeable price impact. One way they conduct their monetary policy is to allow individuals to create and redeem more Tether. Can you compare and contrast that with your approach?
No, in part because I don't know enough about Tether. But I mean, I think what it highlights is there's lots of interesting ways to try and think about stable currency. And I don't think it was a surprise to learn that Tether was not fully backed. And so that there was no price reaction is not that surprising. I don't think anybody believed that they had a one-to-one backing. It was pretty shady all along, but seemed to be working. That's not a surprise to anybody who's, studied high inflation regimes or whatnot. I mean, things sometimes don't work properly, but it is still a bit opaque as to exactly how Tether works, or perhaps I just haven't read it carefully enough.
Yeah,
but
okay.
It's the internet, and so it's quite possible we have people from Tether listening, and there'll be an indictment or a lawsuit coming in my email in the next 5 minutes. Who knows?
Okay, well, thanks very much, everyone. So let's end here so we can have a real coffee break. My technology for making coffee is kind of slow here, so I need the full 5 minutes. We'll reconvene in 5 minutes with Michael Choi presenting.
All right. Thank you all. Nice to see you all.
Thank you, Brian.
Hello, everybody. I think we have time to get back. So we have 1 minute. So, okay, now it's 11. So now we are in time. So yeah, thank you. Okay, let me start. Okay, so that's our last talk with Michael Choi and Luis Araujo discussing. And thank you, Michael. You can take over now.
All right, you can hear me, right?
Yes.
Yeah, okay, and the slide's fine, okay. So thank you very much for this opportunity to present, greatly appreciated. This is joint work with my colleague, Guillaume Rocheteau. Okay. So, interesting in various aspects as reflected in the program of this conference, the blockchain, the smart contract, many things are interesting. Now, compared to many presenters at this conference, we are not expert at all in many institutional detail. I don't know how to program blockchain or write any smart contract. But we are fascinated by one thing, that many of these digital money are privately produced through a process called mining. Now, clearly, the word mining reminds us of gold mining or silver mining. And it seems like this is not a coincidence. According to the creator of Bitcoin, the idea that Bitcoin, although it's costless to produce, in principle, he can create a lot of it. But instead, he chose to have a slow process where Bitcoin is gradually added to the economy. This process is intended to mimic gold mining, okay? And in fact, he said that instead of putting worker and machine into mining, for the case of Bitcoin, it's about CPU time and electricity. So we see there's something parallel going on. The question in this paper is to think about how the fact that these private money are being mined affect the price dynamic and of course the supply of this money itself. We're going to build a model that tries to capture mining to describe the impact of mining on price dynamic, and we would like to apply it to all kinds of mining, for example, gold and Bitcoin mining. We find that it's actually useful to include, I mean, the motivation, original motivation is Bitcoin, but we find that it's actually useful to include all kinds of mining because they will allow us to see clearly what are the differences or similarity between gold and Bitcoin mining. So we can learn something about Bitcoin. So that's the motivation of the paper. Now, what we actually do is we construct a continuous time model with these features. First, well, because we are talking about money here, it's a means of payment. So we would like the transactional role of this money to be endogenous. So people actually need to use this money as to buy things. The money we talk about is a perfectly divisible and durable object. Agents can produce this object slowly over time through mining. We're going to model the time dimension explicitly so that it actually have implication on the price dynamics. And again, we want to keep the model general so that we can talk about different kinds of mining. So we will allow different mining technology. You will see one of the setup is suitable to talk about gold mining, and some other setup is more, it's closer to crypto mining. Okay, instead of the, in addition to the technology, we also talk about the cost of mining. We will allow an exogenous full cost of mining. For example, you put in electricity or computer resources into mining. That's one setup. Another setup is you can think of mining as a job. You have to do an occupation choice. So that will be a good description of gold and silver mining. So we allow both type of mining costs. Now, this paper is part of a bigger project. In the companion paper, Guillaume and I had a similar model of mining, but we do it with indivisible money. So money holding is just 0 and 1. You cannot do anything other than that. That model was useful in terms of understanding all kinds of intuition. But for practical purpose, we think it's good to have a divisible money model because for all kinds of policy analysis, you might want a divisible money model. It's realistic. And also this extension, we have this divisible money model we have here can easily incorporate competing private or competing government monies. So we think that's also useful to understand currency competitions. Now, before I hit the model, a very quick preview of some of the results. The first question is, well, can privately produced money have a positive price in the long run? At least in theory, yes. And we show that if the agents are sufficiently patient and mining is not too easy, so the mining rate is a little bit slow, then it could be, then money can have a positive value even in the long run. And that could be even equilibrium where money is not being used at all as a medium of exchange early on. So people are just initially holding on to this money, look like speculators. And then after a long period of time, endogenously, these agents are going to start trading this money, use it as a medium of exchange, and you will have a transactional and positive price in equilibrium. Second, well, what is the price dynamic of the value of money? We show that depending on the assumptions on mining technology and the production cost, the prices could be rising, falling, or non-monotone. So we view that our model is kind of a mapping from all kinds of mining technology into the price dynamic that you predict. You fit in different kind of mining technology, we will tell you what kind of price dynamic are consistent with the theory. Third, well, it's a policy question. Can the government choose monetary policy of the government money to prevent the production of private money? Well, the answer is yes. We have sufficient conditions such that it can happen. The main condition is that the private money cannot be too wildly acceptable. So it actually relates to the acceptability of money, which I think in the previous talk, I think William mentioned part of it. So it's related to our setup. Okay, so that's the highlight of the results. Now let me hit the environment. It's, for those of you who use the Lagos and Wright model, this is a version of it, but we do it in continuous time. So, well, time of course is continuous now. There are two types of agents. There are buyers and there are sellers. You will see that the role of the buyers is to carry money. So the only decision that they make is how much money to carry and use the money to buy things. And there's also a unit measure of sellers. These sellers are responsible for producing service and goods to the buyers, but they also have the mining decision. So in the version with occupation choice, the seller are going to choose between producing goods and services or mining. In the version where we allow mining to be flow cost, like you put in electricity, etc., to mine, the seller will choose how much effort to put into mining. So the mining decision is on the seller side. There are two goods in the economy. There's a numeric good C that people can trade in a competitive market that's always open. And there's also a tradable good Q that happen that people would like to trade in some pairized meetings. This is the good that is generating the need for money, as you will see later. We assume that all goods are non-storable so that you cannot store the good C in your pocket to pay for good Q. That's just not feasible. We assume enough things so that you have to use money as a means of payment. Now, let me talk a little bit more about these pairized meetings. This meeting happened between buyer and sellers, and it happens at a Poisson rate of alpha. Once there's a meeting happen, there's single coincidence of one. So the buyers want something from the sellers, but the seller don't decide the buyer to produce anything. In particular, the buyer have a utility function U of Q for the consumption good Q, and the seller can produce good Q at the linear cost. Okay, so this utility is just Q itself. So this just to make sure that's gain from trade in producing Q. We assume these agents are enormous and they lack commitment. And because of these frictions, you cannot borrow money or not money. You cannot borrow output from the other side of the market because the buyer cannot commit to repay in future. And because of this, there's a need for using money as a means of payment. So the buyer would like to carry some of this money asset. So what is money in this model? Well, it is a perfectly divisible and durable asset that pays a dividend, potentially strictly positive, but it can also be fiat money when D is 0. In between the pairized meeting that happened at Poisson rate alpha, this agent can go to the competitive exchange to produce the numeric good C in exchange for money. So the competitive exchange are just for the agents to restock or to spend their money if they earn anything from the bilateral meetings. The price of money in terms of the numeraire C is phi T. And because of that, the rate of return of money is given by the sum of D, the dividend, plus the change in the value of money divided by the value of phi itself. A crucial feature of this model is that money is being privately produced. So the supply of money is endogenous. We're going to use AT to denote the supply of money at time T. And the cap A bar here is the upper bound of total amount of money that you can produce. So if you think about gold mining, A cap will be the total amount of gold available in the planet. That is A bar, sorry. Here's a picture to talk about the timing of the economy. It's actually not complicated. So there's a competitive market always open, as shown by this blue arrow. Now, for the agents, at Poisson rate alpha, the pairwise meeting will occur. Once you're in a pairwise meeting, you cannot simultaneously be in two meetings. So you have to get ready. You have to have enough money to prepare for the meeting. So suppose the meeting happened at T1. At that moment, you will be using the amount of money in your pocket to buy things from the sellers. Now, once the meeting is over, if you have spent all your money, you could immediately go to the competitive exchange and restock your money holding. So this is a nice trick in the Lagos and Wright model, because by then we don't need to keep track of the entire distribution of money. You always carry the optimal amount of money that you want. For the sellers, once you earn the money in the pairwise meeting, the sellers don't need money, so they immediately spend it in the competitive exchange in exchange for the numeric good. So the CM is for people to load and unload money. And yep, that's it for this slide. Okay, so far everything I said is actually consistent with the standard Lagos and Wright model, so nothing super new so far. It's just the continuous time version of it. Now I'm going to talk about the new feature, that is the mining technology and the mining cost. We assume all the sellers, they can choose their mining effort, which we use E sub I to denote. I is the identity of these sellers. And the aggregate mining intensity is simply the integral of all these individuals' mining effort. Now we assume that for individual to discover 1 unit of money, the way at which they discover money is given by the product of two terms. The first term here, lambda, capital lambda, is the individual discovery rate of mining. And when it is multiplied by the mining effort E here, that is going to be the discovery rate of money for an individual. We allow, so E is of course the choice of an individual, and lambda here is potentially state contingent. It can depend on the current supply of money, and it depends on the aggregate mining effort as well. So the first example that I would like to talk about is gold mining. In the case of gold mining, we assume capital lambda is the product of two things. Small lambda here is a parameter, it's a constant that controls how fast you can discover gold. A bar minus A is the amount of gold that's not discovered by people yet. So it's the remaining amount of gold reserve in the planet. The bigger it is, the easier it is for people to discover new gold. So we think this is a reasonable description of gold mining. Now, in the case of crypto mining, in particular, we are having Bitcoin in our mind. So supply of Bitcoin is given by exogenous process that's controlled by the designer. So we assume there's an exogenous money growth rate pi here, which is a function of the current supply of money. And to discover 1 unit of Bitcoin, it depends on the competition that you're facing. If other people are mining very aggressively, it gets harder for an individual to discover Bitcoin. So we divide the growth rate of money by the aggregate mining intensity. So we are essentially spreading or giving out this new Bitcoin to people according to how much effort they're spending on mining. well, interestingly, in the case of Bitcoin, the money growth rate can be approximated by a certain exponential function. It will just take this functional form, which in some sense very similar to the gold mining. It just is, yeah. Okay, so that's on the technology side. The next thing is the cost of mining. What is the cost of mining? We use this capital C function to denote the mining cost. We allow several setups. The first example is the occupation choice setup. So you just choose to mine or not to mine, as shown by 0 and 1. We say that C1 is the cost of mining if you choose to be a miner, and we allow this cost to be state dependent. So it can be endogenous, depend on how much you have to give up to be a producer. So this captures the idea that for gold mining, you have to reallocate resources. You cannot do your regular job anymore. You have to become a miner. So if your regular job pays you a lot, then the opportunity cost of gold mining is actually bigger. So that's the setup for occupation choice. For crypto mining, a lot of time people would like to think, well, you can do multiple jobs at the same time, so it's not really an occupation choice. So in this case, you can assume that it's simply a flow cost, K times E as the cost of mining. K in this case will be the cost, will be the amount of electricity or computational resources you put into mining, and K will be the unit price of electricity. Of course, in reality, you can do a combination of these two things. You don't need to go to the extreme. Okay, so so that's the setup of the model. In the rest of the presentation, I'm going to talk a little bit about the equations, but not much. And then after that, I'm going to show you the price dynamic that our model can generate. So just a few equations. Oops, sorry, okay. So on the buyer side, the only decision for the buyer, again, is to choose the money holding. So the buyers, they're impatient, the discount future at rate roll. So the main cost of carrying money is exactly because of the impatience. If they have to carry money, that means they cannot consume today, they have to work. So here, for an agent with a unit of money in his pocket, if he chooses to carry 8 stars so much money, then the cost, it would depend on the discount rate roll. Once you carry money, you get a financial return. So that's captured by the rate of return small r here times the amount of money that you have. Another benefit of carrying money is the transactional roll. You can use it as a means of payment. So that is captured by the bilateral meetings, which happen at Poisson rate alpha. Chi T here is the chance that the seller is going to accept your money. If you're running into a seller who is busy mining Bitcoin, then that person cannot accept your money. So chi is the chance that the person is accepting your money. And then once in the meeting, there will be gains from trade captured by this term U of Q minus Q. That's the total gain from trade generated by the production of Q. We are assuming in the bilateral meeting, people clear the market with Kalai bargaining. So theta here is the bargaining share. The buyer is going to get a share theta of the bargain of the total surplus. Because we are talking about non-stationary dynamics, we need to think about how the value of this agent change over time as well. Now, next, the seller's decision is, oops, okay. It's basically to choose to mine or not to mine. So E is either 0 or 1. If you choose to mine at Poisson rate lambda times A bar minus AT, so this is the equation for the gold mining. You're going to discover 1 unit of money. And the value of money is phi, so that's how much benefit you're getting out of mining. If you choose not to mine, then you become a producer. So at some Poisson rate alpha, you're going to meet the buyer, and you're going to get 1 minus theta share of the trade surplus. So that's the benefit. Clearly, for the seller here, the decision to mine just depends on the instantaneous gain of mining versus that of producing. So that is going to capture the mining decision. Now, altogether, the economy is captured by a pair of A and phi. So at any instant, we need to keep track of how much money is already produced by these agents, and also the value of money at this instant. So you can expect our economy can be represented by some two-dimensional phase diagrams. The aggregate law of motion for money supply is simply the individual discovery rate of money times the aggregate mining effort M. So we're just adding up the individual discovery of money. This last equation here, the exact functional form doesn't really matter. I just want to show you how the equation look like that describe the value of money. This is essentially deriving from the first order condition for the buyers when they choose money holding. So basically the pair of equation here, these two equations, is going to dictate the dynamics of our economy. Okay, that's it for the equations. So here's how equilibrium looks like. On the left panel here, the red line is the indifference loci, where above the red line of money is high enough so that all the sellers would like to mine money. Below it, no one wants to mine money. Now our economy is going to start it's going to follow this green arrow, start with no money at all. So A is 0, and then it's going to gradually converge to the steady state of the economy, which we denote as AS and VS. There are several things that is interesting, we think, in this figure. The first and the easiest thing is the value of money, of course, is always above its fundamental value, which is D over R. So of course, it cannot be lower than that. And the fact that the green line is always above the red line means that along the transition path, agents are always strictly preferred to mine in this example. So what happened is people are going to mine the money and they're not going to use it as a medium of exchange because all the sellers are busy producing producing gold and silver. They are not producing anything in terms of goods and services. Until the economy converges to the steady state, suddenly people will switch occupation and start producing producing the good Q. There could be also another example where the green line initially is strictly above the red line, but at some point hit the red line, and then the producers start producing, and the economy gradually converges to steady state. That is possible as well. Now, one important feature in this picture is why the green line is upward sloping. It's kind of opposite of the quantity theory of money, because along the grid line, the supply of money is increasing, and so is so does the value of money. Both of them are increasing. The reason is that as A increases, in the case of gold mining, it gets harder and harder to discover one more unit of gold. And in order to justify mining, the price of money must be going up as well, so that the miner are willing to spend the effort to mine. So at the end of the day, you have the opposite prediction of the quantity theory, so that phi and A are both rising. In this setup, depending on the value of D, the dividend you get from money, you can also have a version where when D is very big, then the liquidity premium of money completely disappears. It's just value fundamentally, so that even if you're mining, the value of money is constant over time. It's just a value at D over R. Now, so this is the prediction of the commodity mining model, like gold and silver. Now, let's move one step closer to what we have in terms of mining digital money, but not quite there yet. So first, let's think about fiat money. Suppose this money is fiat. Now the fundamental value of it is 0. So we actually suddenly have a lot more equilibria. Instead of just the one green line that converges to steady state, now we have a set of green lines. In fact, we have a continuum of it. We have many other equilibria where people are initially mining money, but at some point the green line hits the indifference loci, and then people suddenly stop mining because the supply is high enough, they lost interest in mining. And at that point, the value of money is going to fall and eventually vanish. So it's dropping vertically, meaning the supply is not changing. We think this equilibria are kind of interesting because these are equilibria where you have a new money and it's destined to fail. But yet people are still willing to spend resources to mine the money early on and use it for a while as a means of payment, perfectly knowing that the money is going to eventually disappear from the economy. So we think this might be telling us something about the crypto money that we see sometimes that people trade for a while, but they know that it's not going to last forever. But yet still early on, people are spending resources to mine it. The right panel here, this is an example when we do the comparative static, we change the total supply of money. So it's mimicking a gold discovery. If you discover a new supply of gold, or maybe the total supply of Bitcoin increased. So it's a shift in the A bar. So we think it's kind of like a California gold rush. Early on, you follow the equilibrium path until the steady state. Once you have new announcement of gold discovery, the value of money suddenly drops for two reasons. One is because now there are more gold available, so people don't value each unit of gold as much. The second is a lot of people are switching from producing goods and services into gold mining, so that the value of money goes down because there are not many goods and services you can buy. So it drops, and then eventually people are going to switch back from mining into producing, so the value of money increase, and then you have multiple price rate, depends on how much money you discover. Okay, now let's move on to think about what happened. How does the model change once you replace the assumption for gold mining into assumption that we think are suitable for Bitcoin? So again, now the supply of money is exogenous. It's following some predetermined money growth rate pi. And now the seller's decision is to choose the mining effort, which is any real number. The higher the mining effort, the more flow cost you have to spend, but there's a higher chance you get a unit of Bitcoin. So pi here is the growth rate of Bitcoin. The real balances C is just the product of value of money and the total supply of money at the moment. So pi times C is the value of new Bitcoin that's generated. We're going to split this among the agents who are spending the mining efforts. That's why we divide by M. The higher E you choose, the higher chance you get a new unit of Bitcoin. So that's the decision for the seller. For this version of the model, we show that the real balances. So notice that is a little bit different from the previous one. The last one, I have the price of money in the y-axis. Now it's the aggregate real balances. We show that there's one equilibrium where the aggregate real balance can increase and reach a steady state. But there's also a continuum of equilibria where either the value of the real balances of money either increase and then fall to zero, or it just keep falling over time. In this equilibria, we show that although the total real balances can be non-monotone, the value of money is actually falling over time, so it's monotone. So again, it's not the same as gold mining, but we think it shares the same feature that you can generate boom and bust in terms of the total value of money. You can have people knowing the money is going to fail eventually, but still early on willing to hold it, trade it, mine it, and then just trade it until the value of it vanish eventually.
Michael, you have 2 minutes.
Okay. Yep. Okay. So I will spend the last 2 minutes on how to extend the model to talk about competing monies. So there are two ways we're doing it. One way to do it is to think about two private money. They are perfect substitute as a means of payment. They can both generate the same dividend, full cost, and because they generate the same dividend and they are perfect substitute as a means of payment, you can have they're going to have the same price in equilibrium. So the difference of the two private money is going to have different total supply. So the total supply of gold and silver can be different in this economy, and the mining rate for these two money can be different as well. So if we extend the model that way, instead of just one indifference loci, we have two indifference loci. We have one loci that talk about you're indifferent between mining one money or not, and then the other loci that talk about you're indifferent between mining both money or not. The relevant indifference loci is going to be the lower envelope of the two of them. So in this particular example, what you see is early on, people are mining gold. The money that we assume is easier to mine in the example, they strictly prefer to mine it until you hit one of the indifference loci. Now you're indifferent between mining gold or not, but you're still mining because you're indifferent. At some point, the amount of gold exhausts is getting harder and harder. So you start to mine silver as well, which is early on harder to mine, but later on as good as gold. So you are mining both kind of money until you reach steady state. So in this setup, we have predictions about whether in the long run, you're going to use both types of money, or you can just use one type of money. The key condition is that if the difficulty of mining gold and silver are very different, if gold is much easier to mine, then in the long run steady state, you just mine gold and just use gold. Silver will never circulate. If the difficulty level is sufficiently close, then eventually you transition to the steady state with two monies. The very last thing I'll talk about is how to talk about private money and government money in the same model. So we have a version of the model where there are three types of meetings. For this pairwise meeting, in some meeting, you have to use government money. It's like paying tax. You have to use government money to pay tax. There's some other meeting, you have to use Bitcoin as a means of payment, like when you do criminal transactions, buy drugs and illegal things like that, you use Bitcoin. There are also meetings where you can use that kind of extension. I'll skip the equation here. The crucial insight is that if the government can use monetary policy to control the value of government money, then there's a condition we derive that the government can drive out the private money mining. So they completely discourage mining money early on so that in the long run, it won't circulate as well. And the condition crucially depends on two things. First is the government money must be sufficiently valuable. So the government have to be maintaining the government money so the inflation rate cannot be too high. The second thing is the acceptability of the money. Alpha is the way at which this bilateral meeting happens. And gamma is the probability that people accept Bitcoin in this meeting. The product of these two terms have to be sufficiently small so that the government can actually drive out this money. So it kind of against which refer back to the point that William was mentioning early on, acceptability actually matters in this setup if you want to drive out government money. Okay, I'm out of time, so I will just conclude very quickly. We build a model that we think we can talk about mining of various kinds. It can be commodity money mining, or it can be crypto money mining. Again, we think the insight is that once you put both of them into the same model, you can compare and contrast the similarity and differences. It actually deepens our understanding about crypto mining. Some of the new insight is that you can create this boom and bust phase. People are perfectly rational in this model. They have perfect foresight. So even if they know the money is going to disappear, still you can generate a boom phase for this money. That's one of the new insight. And also you can have value of money and the supply of money increase over time as well. The one extension, there are several extensions. One extension we think is potentially interesting is to talk about the competition among currency designers. So in this model, we assume the growth rate of Bitcoin is exogenous. It's just a pi function. But in principle, you can have currency designer to design this function and compete with each other, see which money will survive in the long run. This is kind of similar to the exercise that Fernandez Villaverde and Daniel Sanchez did in the JME paper. But if you apply our framework, you can take the idea and then also talk about the mining dynamics as well.
Thank you, Michael. We'll welcome Luis Araujo for his discussion. You can stop sharing your screen so Luis can start sharing his. Thank you.
Okay. Can you see that?
Yep.
Great. Thanks for the invitation to discuss this paper, which I really enjoyed reading the paper. And as Michael said, this paper follows up on a forthcoming AJ macro paper that they have, in which they study the dynamics of prices when money is mined to a time-consuming technology. The difference is that in the AJ paper, they based on Trejos and Wright, which is an indivisible money setup. And here they extend their analysis by introducing divisible money, which then allows them to talk about currency competition and other things. So In the paper, they have both like money paying dividends and money not paying dividends, like fiat money. I'm going to concentrate here more on the fiat money part so I can be more efficient in the use of my time here. So as it refers to fiat money, what they obtain here is similar to what they have in the AJ macro paper, which is that there's going to be a unique equilibrium in which both the value and the quantity of money increase over time and converge to a steady state. And they also have a continuum perfect foresight equilibrium where the quantity and the value of money first increase over time and then the value of money decreases and converge to zero or the quantity remains constant. Now, equilibria, self-fulfilling equilibria with a constant quantity of money and where the value of money goes to zero, these are common in monetary models, like these are the hyperinflationary trajectories that we usually get in search models or LG models. Now, equilibrium where both the value and the quantity of money increase over time, these are not common. And that's where I want to talk a bit more, because that's a lot driven by the money mining technology. That I think is a good value that's added by this paper, is to get to this type of results that have to do with the supply side of money through a different type of technology. So just to get to this point, here I have like a summary of the two main equations, like the main elements of the model. So in the first equation, here is just the usual demand for money equation in which you have the opportunity cost of holding money on the left side. And then you get two benefits of getting money. This fundamental benefit here, which is how the value of money increases over time, and a liquidity premium, which, I mean, that's a point where the money mining thing is going to matter. It adds this 1 minus MT here. So the idea is that only if you're not mining that you get to produce. So this enters here, which is not the standard we get in monetary models. No? And then the second equation is the evolution of money over time. Then we get two new pieces that also come from the technology here. First is the endogenous component, the idea that the number of miners is going to matter for how much money you get to produce, and the idea that the mining rate decreases in the stock of money. Okay, and then the money mining decision is simple. It's just like you look at the costs and benefits here, and if the benefit of mining is larger than the benefit of producing, you're going to mine. If it's lower, you're not going to mine. And I'm looking here at the constraint case in which you don't get to the efficient quantity, just to simplify the discussion. That's this 58T here. Okay, so that's kind of a summary of the elements of the model. And so what happens in this boom phase? So as Michael was saying, in the boom phase, everyone is mining. So MT is equal to 1. So this liquidity premium disappears. The only thing you have is the increase in the value of money over time. And that's how we get the boom. So the idea is that since you cannot get any benefit from the liquidity part, you're going to get some benefit from the fundamental part for people to be holding money. So the value of money has to increase over time. But the thing is, there's this trade-off between the fundamental return and the liquidity return, which kind of drives the trajectory here. So what I'm going to do, just to shed some more light on this trade-off, I'm going to make a small change in their model by introducing this parameter delta here, which is the idea that not every producer can be a miner. There's like mining skills that we have to acquire, and these skills are going to arrive at some rate delta. And I'm going to add that to the model. And what happens is when you add that, it doesn't change anything as it refers to the main equations. See, these are exactly the same equations I had before, The only thing that's going to change is that now the number of miners is going to be constrained by this delta rate. So not everyone can be mining anymore because not everyone got these skills to become a miner. So I think it's a simple extension because it doesn't change anything in terms of steady state. It just changes the trajectory because now when you go to the boom phase, you're not going to eliminate the liquidity premium part. You're going to have this part where everyone that's not a miner yet still are going to be producing. So you get some liquidity benefit, you get some fundamental return. We are back to their setup if the delta is equal to infinite, but the delta is finite and these two things are there. And if the delta is small enough, you don't get the boom phase anymore because you get enough out of the liquidity premium that doesn't rely on, they don't need the fundamental value to increase in order to compensate for the discount rate. So then you get different types of trajectories. Okay, so my point with this small modification is just to highlight that these delays in trade, they're quite important for the creation of the boom phase together with the, and I think in my interpretation here, you get the boom phase through the delays in trade, and you get the end of the boom phase because you have this mining rate decrease in the stock of money. Again, it's nice that you get the boom and then you get the conversion to the steady state, or you get this hyperinflationary trajectories later on, because the decrease in the mining rate kind of slows down the trajectory there. No? So another thing that I want to highlight is this, is that these are things that we don't observe usually in standard models of money. This really has to do with this new technology that we get here that's able to generate this type of trajectories, which I think is nice. I mean, in the sense that maybe a more general message you get out of here is that as long as you have some delays in trade or some decrease in returns, you're going to get trajectories like this. It may not necessarily be coming from a mining type of process, but could be some other type of process. But the mining rate kind of gives a good benchmark to think about that. And just, I don't know how much time I still have, Bruno. Can you tell me? Hey, we need to unmute you.
Sorry, 1 or 2 minutes. That's enough.
Okay.
You started microevents a little bit there.
Great. So the only other thing that I think is nice is that, I mean, this technology that they have in the first part of the paper is not much a cryptocurrency type of technology because the money supply is endogenous. But then in the paper, they consider a case in which the money supply is exogenous. It's nice. And but then the model is so flexible that I think one interesting extension you can get out of that is to go one step ahead in terms of mining, money mining like Bitcoins, is that mining has to do with validating transactions too, which is something that they do not explore. And my point here is just to use that to show how flexible the model is to get to this type of things. So what I'm going to do is just this additional change here, in which I'm going to add the same exogenous process for money creation they have there. And I'm just going to introduce this idea that more mining is necessary for validating transactions. So the alpha, that was the arrival rate of trading, kind of relates to the amount of mining, because you need mining to validate, to generate transactions. And then another thing that you need is you need to create some compensations for people to mine. Huh? So part of that comes from new money that can be given to these people. But if you get to the steady state where the amount of money is not going to change, you need some additional source of revenue. And I'm thinking of this as some money that you could kind of tax people and give to the miners so they get compensated as well. So that's just things that you can add to get to this validation part. And my point is just that you can just plug that into the model. It's pretty much very similar to what we had before. The only thing is that now instead of alpha, you get this MT here because you need mining to validate transactions. And the decision of the miner now depends on this new way of getting money. And it's pretty simple because the model kind of allows for these things to be done. And just for instance, if you get these and you look at the steady state of that, You get some system of equations here that you can solve for the number of miners, for the value of money, and for the quantity. And one thing that kind of interesting that you can get out of this is that this gamma, which is like taxing money, with like inflation in some of our models of search, it can actually lead to an increase in both the quantity and the quantity of trades. Like it's an idea like inflation can benefit both the intensive and the extensive margin of trade, which is something that we usually don't get in monetary models, but we are able to get here because we have this different type of technology that's driving the process of money creation. So the bottom line is, I think this is a very nice paper. I think there's not much work on the supply side of money, a lot of work on the demand side of money. Now with cryptocurrencies and digital currencies, we need more on the supply side. This paper is a really nice contribution to this literature. I really like the result that they get these boom and bust trajectories that allows us to relate like to this bubbly-like kind of behavior that we see in cryptocurrencies. So it seems a very interesting and useful paper, and I'm really happy that I had the chance to read
Thanks.
it. Recommend people to do that as well.
Thank you, Luis. Michael, do you want to reply to some of the points Luis made? And then we can start our Q&A.
Okay, then I'll keep it short. I'll answer two things maybe. So Luis mentioned that it's crucial that some of the result depend on the fact that trade doesn't happen early on, it happens later. So that's true. In the paper, actually in the earlier version of the paper, in the AEJ macro, we find the reason that you have delay in trade early on and then consumption only later is partially due to the matching function. It's the kind of matching function that we assume that is driving this result. If instead we assume a more standard Cobb-Douglas kind of matching function, you can actually have a little bit of consumption even early on. Very little, but you have a little bit. So you have both, you have consumption over time, throughout the time, but you have very little bit early on, but the velocity of money is going to gradually increase. So in that case, the model is actually similar to our benchmark model, but now you don't have delay in trades. You actually have trade even in the very beginning of time. So some of those results, a lot of those results will carry over to that version with a general matching function. And your extension, Luis, of having mining to validate trade is great, it's wonderful. We also acknowledge the fact that we are not talking about what mining is really changing the monetary system. We don't do that because we are not sure what is the best way to do it. It seems like you can help to validate more trade. You also help to, like you said, you also help to improve the security of money. I think Pat Nota has a paper about that. So in our mining paper, we choose actually not to say too much about it at the moment. We let the users of this model to embed what they think mining is about into the system so that they can cater the model for their own kind of crypto money. But you're exactly right. That is the feature that we did not include in the paper, which is kind of important. Yep.
Thanks. We had a lot of discussions in the chats, and we have some questions in the Q&A. So Charles, you had one question in the chat. Do you want to go ahead and ask? Charles Khan?
Yes. And you may have gotten through this briefly from the discussion, but I'd like a little bit more on it. So in Bitcoin, mining is a rat race. The speed of the growth of the money supply is sort of fixed, and then as a miner, you simply do more effort and you get more chances at winning, but the other guys lose in the process. If we make the mine, and as I understand it in the way you presented the paper first, growth of money supply is endogenous in this story rather than exogenous. If you change that, apparently you've got that in the paper as well. What does that do to the dynamics that you're describing if we make the growth of the money supply exogenous and put it all in the effort on the mining?
Okay, great question. So it of course depends on the detail, but one simple thing is once we change the assumption into the Bitcoin mining kind of assumption, the value of money is actually always falling. Okay, unlike the gold mining version, it can be non-monotone, but it's the real balances of the aggregates of part of money that's non-monotone in the crypto mining version. So it's, you can still have the boom and bust phase, but it's in the space of the real balances. That's one difference. So I didn't put it here, but introducing that kind of alternative mining technology like Bitcoin, you can also introduce other kind of endogenous fluctuation, because now you will depend on how many miners are there to compete for the new Bitcoin. So they can coordinate to mine a lot or mine very little. That is going to create endogenous fluctuation in money. Yep. Thank you.
Was like Carlos Esquivel is having a discussion with Todd about why the price of money is a state variable. Todd, do you wanna introduce that question? Or I can try to unmute Carlos.
Well, yeah, okay. So Carlos is just asking, so what, yeah, as you said, why is the price of money a state variable? And in many equilibria, it seemed like the price of money was pinned down by A, the current quantity.
Right, I probably give the wrong impression. It's not a state variable, but when we draw this phase diagram, all you need to do understand the dynamics to keep track of phi and A. But phi is not a state variable. A is a state variable. But of course, different equilibria, it's not just the state, right? You're also driven by self-fulfilling beliefs. So you need to have that as well. So phi is kind of reflecting some of it. But again, you're right, it's not a state variable.
I was curious, maybe just a clarifying question. When in the equilibrium that the price goes to zero, is that asymptotically going to zero that like has a time t that hits zero?
Yeah, okay. So that refer back to Cyril's question. So in the phase diagram, it looks like a vertical line that drops to zero, but it's a phase diagram. It's not the time dimension. If it draw in time dimension, it's going to increase, and then it falls at an exponential way to zero asymptotically. So it doesn't hit the finite time that you have zero value for money.
Okay.
Yeah.
Then can I bring up Russell's question, which is answered, but I didn't fully understand it. So he was asking why aren't the miners holding on to the cryptocurrency? If the price is rising, why aren't they just holding it on and selling it later?
Oh, wait, okay. But because of the competitive exchange, you can just sell it whatever value you value the money. So the other side of the market will take the money. You value it really high, the other side will just buy it. So you're indifferent between buying or selling, selling or holding. Yep.
So I'll bring something up. Like this is more related to some of your discussion already. If in reality, mining also takes capital. You don't have capital in the model. Like, how do you think about that? Like, do you think that can be growth effects if like people are reallocating like schools to mine and things like that? Or you think that's a minor detail?
No, I don't think it's a minor detail. So you will go into part of the assumption of the cost of mining. So if you have capital, well, in some sense similar to have endogenous entry for the miners. So you have to invest in capital in order to enter. So I think it's going to have implication on the mining dynamics. So it's a good point. We didn't think about that. We don't have entry in the sense of buying capital. We just have full cost because we are thinking, well, nowadays we all have a computer. You can mine a little bit anyway. But you're right. But if you want to get serious, like a mining pool, etc., of course, we should think about capital very seriously.
So back in 2011, I built a gaming computer that I would let my GPU mining in the background when I was not gaming. That went down very fast. So soon enough, they were like they were building this huge cluster computers specializing in mining. So right now, it's not like you can just. There was a time that there was apps in your iPhone that you could put to mine. This just doesn't exist anymore. It's just so competitive that you cannot do these things anymore.
Yeah, now it's not a hobby anymore.
Yeah.
So can I clarify something real quick? So I guess I think Todd summarized my question really nice. So but I think my point is, okay, if the miner expecting a real fast appreciation of the Bitcoin price, so they can just hold it a little bit and sell it later. So and I think that may be equilibrium selection device. So some of the equilibrium path should not exist because of this arbitrary opportunity. So
I see.
in the end, so that may help you to maybe something about uniqueness. That's one thing. So and another thing is that I think Luis make a great point. So so in the DM, that kind of the matching Poisson rate may be tied to the mining rate actually in the Bitcoin world. So because the mining is come from verifying the transaction, so then the two Poisson rate can be endogenous and correlated with each other. So that may be good to check. So if you have a mining more and more Bitcoin, it may be more and more easier to approve the transaction. Then you can trade faster. Then that can create another cycle as well. That might be interesting. So I think Luis make this point. I think that's very nice. And on Charlie, so I think so the thing may be already incorporated in the matching function. So about the red racing. So if other people are mining like crazy, so it will generate a congestion event in the denominator, I think in the matching function. So that will make you less likely to get the Poisson rate as well. So I think that feature captures some of it.
So all great points. Yes, thank you, Russell. So the first, so you mentioned about refining the equilibria. So it turns out in our model, if B is strictly positive, can be arbitrarily small, you already have a unique equilibrium in our model. Only when it's exactly zero, you can get all this continuum of equilibria with boom and bust. So Luis also mentioned that already. In the paper, I didn't mention, so we actually have a version or extension where the acceptability of money is evolving over time as well, together with the money supply. So we can make the acceptability as a function of time or the supply of money. So you can change over time, but we haven't extended in a way that Luis suggests that is directly linked to the measure of miners. But still, you can extend our model to talk about time varying acceptability. So that's doable. And the last point you mentioned is exactly right about Charlie's question. So in the Bitcoin mining, we already embed the red race into the mining function, right? If other people are exerting a lot of effort, it gets harder for one individual to discover money. So that's, you're right. It's part of the assumption.
So thank you, Michael. And I think with that, we are going to end our workshop today. So
Bruno, can I jump in real quick? So we had a few extra minutes built in. I was hoping we could fit in one more question because I think Rod wanted to ask something.
Okay.
Yeah, sure. I was going to just emphasize that, I think taking account of the cost of the mining equipment or the capital requirement is pretty important. Martin and I have a paper that looks at that, but I was just going to raise this point that there's also an interesting game theoretic issue involved in that because of the fact the way that the mining protocol adjusts, if the mining power increases, the protocol adjusts to make mining more difficult, and so that creates an interesting game in itself. Because when new mining technologies, more advanced specialized chips are being built all the time. And this creates kind of an interesting prisoner's dilemma because when a new chip comes out, everybody would prefer if no one used it because they could just keep mining the way they are, maintain the exact same shares. But if a new chip comes out, they all have to buy it. And then once they all buy it, they're back to equal, to an equal playing field. So the only thing that's happened is they've had to undergo this huge capital expenditure and nothing else changes. So there's lots of interesting things to think about in terms of introducing essentially the capital requirement into Bitcoin mining. So
thank you, Rob. Yeah, I think that's a great comment. You can, totally. You can invest in entry or like equipment, like you mentioned, you can improve the equipment. Yeah, that would be really interesting to help us to think about the energy consumption of Bitcoin mining, right? You can model it as a game, and there probably will be multiple equilibria, I suspect. And so that will speak to some really interesting policy issues about energy.
Well, that may be related to Rob, his point. So I think another game theoretical setting is, I will be quick. So is that, so in the real world, so the miner, they are actually mine in a collision, right? So they share their own computation power, and then if someone hit the jackpot, so they share the block, the Bitcoin in some allocation rule. So that might be another layer so to consider. So they have some endogenous risk sharing about the mining. Yes.
Could model it as formation of coalition of these miners into mining pools, or directly model the mining pool competing with each other. Yep, I guess you're right.
Okay, thank you. Todd, do you want to have some closing remarks?
Yeah, so I'll just say thanks to everyone, to the presenters, especially to the discussants, and to everyone who attended and contributed with questions. So we'll start again tomorrow, 8:55 a.m., or I guess we're going to call it 9 a.m. tomorrow, so you get 5 extra minutes. So today was a mix of central bank digital currencies and private digital currencies. The next 2 days we're going to specialize. So tomorrow is going to be 3 papers about central bank digital currencies, starting with Steve Williamson in the morning. I think it's going to be a really interesting day. Friday, we'll come back to private digital currencies. So thanks, everybody, and look forward to seeing you tomorrow.
Thank you.
Thank
And
you.
with this, yeah, thank you, everybody. And now we are officially ending the recording.